Hello everyone, Radhe Radhe. In today's lecture, I will be covering interest rate risk management topic, which we also call as IRRM. I'm going to revise all the concepts of this chapter in detail. In our regular classes, we covered this chapter in 5 parts where we studied about 11 topics. After covering all concepts, we also solved every question in full detail, so you must have had no issues. This chapter is very easy. So today let us now revise all its concepts in detail once again. This will help you prepare very thoroughly for your upcoming exams and you will not face any problems. When I taught this chapter initially, I mentioned something important and I'm going to repeat it again now. And this chapter doesn't really have a separate existence on its own. This chapter is actually an extension of the derivatives chapter. It is a clear continuation of the derivatives chapter that we have already studied. All the logic and concepts in this chapter are the same as I have already taught you in the derivatives chapter. There are no new concepts or new logic here. We will just be interpreting them from a different perspective, but the concepts and logic will be exactly the same. I said this in class as well, that I have explained the logic and concepts of derivatives in detail. We will now apply them here. So we won't go into too much detail about them here. Besides, this is a revision video. So we generally don't go into extreme detail in these, but I will still do my best to cover all the concepts. But since everything from the derivatives chapter applies here exactly as it is, anyone who has not studied or revised it should definitely do that first, because this chapter truly contains nothing new. It's a continuation of the derivatives chapter, and as I have already mentioned before, when you watch movies, they often come in distinct parts like KGF 1 and KGF 2. If you watch the second part of a movie first, you won't get the full clarity. It's the same with this chapter. It's not a new chapter that exists independently. It's a continuation of derivatives, so you can think of derivatives as part 1 of a movie, and IRRM is part 2 of that same movie. So before understanding this part, you must understand derivatives. Make sure you have a good grasp of derivatives, otherwise this won't make sense and you should skip it. If you haven't studied or revised derivatives yet, this is going to go right over your head. But if you have, then this chapter is nothing. It's very easy and short. Your concepts will be revised quickly and you won't face any issues. Now to understand what we learned and studied in this chapter, I first created part 1 for you, which was the introduction to interest rate risk management. What is this chapter about? What does it teach you? What did we learn in this chapter? In this chapter, I'm saying that this is a continuation of derivatives. So you might ask, sir, can you tell us a bit about derivatives so we know how this is a continuation? That way we will understand what to learn in this chapter. So in derivatives chapter, I explained that derivatives can be of many types and they can also be classified in different specific ways. When I enter into a contract with another specific party for a future transaction or to clearly bet on the price of something, then that is called a derivative contract. The underlying asset in that contract can be of many varieties. We talk about 4 things according to our syllabus. If the underlying asset in the derivative contract is equity like an equity share, then it's an equity derivative and we have studied it in detail in the derivatives chapter. But if the underlying asset in that contract is a commodity, then we call it a commodity derivative and we have covered that completely in the derivatives chapter as well. Besides these, I had told you about 2 more underlying assets and one was currency. We used to call that a currency derivative, for which you have a separate forex chapter. And I also mentioned that if the underlying asset in a derivative contract is an interest rate, then we simply call it an interest rate derivative, which, as I told you, will be covered in the IRRM chapter, and this is that chapter. In this chapter, you will primarily study derivative contracts where the underlying asset is the interest rate itself. Derivative contracts whose underlying asset is the interest rate are called interest rate derivatives, and that concept is covered in this chapter. There's nothing else in this chapter. This means it's a direct continuation of the very vast derivatives chapter. It isn't limited to just one chapter, and that's why we often think that chapter is very vast. But this is very easy. It's a very small portion that's in this chapter. The main portion was covered in the derivatives chapter. The part in this chapter is a small one, so we will complete it quickly. You won't face any problems if you have understood derivatives well. In this chapter, we have to study interest rate derivatives, meaning a derivative contract where the underlying asset is the interest rate. We will study that concept here. And the rest of this chapter then very majorly focuses on how we can properly use interest rate derivatives to manage and hedge our interest rate risk. If I have an interest rate risk, how do I properly hedge it, eliminate it, reduce it, or efficiently manage it? This entire chapter focuses more on how to effectively do that. As I previously told you, derivatives can certainly have different purposes. This chapter focuses on properly using interest rate derivatives for the purpose of hedging. There might indeed be other parts, but the very main focus of this chapter will always be on the hedging aspect. How can we hedge using interest rate derivatives, and how can we properly reduce our financial interest rate risks? So we will discuss all about how everything is going to work. That's why this chapter is named interest rate risk management. If you have an interest rate risk, then how will you manage it? Means the chapter talks about hedging it. So the chapter's main focus is on what its name suggests. So we will study interest rate derivatives with our main focus on the hedging part. So to learn this chapter, first grasp some basic concepts, temporarily setting aside derivatives. What were those basic things? What are the possible types of interest rates in the market? I explained there are two types of market interest rates. Not discussing derivatives now. These basic concepts are crucial for this chapter. This is interest rates chapter. Since you are studying interest rate derivatives, all discussions will revolve around interest rates. Underlying asset in derivative contract will be interest rate. So you need to know about the different types of interest rates. Otherwise, this chapter will be of no use to you. In the market, you see, there are two main types of interest rates, fixed rate and floating rate. What are these? You can understand them by their names. These are basic concepts, not in the syllabus, but I am explaining them so you don't get scared seeing them in questions. Fixed interest rate, meaning whenever you talk about interest rates, remember that the interest rate is never alone. Wherever interest rates appear, a loan will be with them. The topic of loan will automatically come up. Okay, the topic of loan will automatically come up. When we are studying this chapter, the very concept of a loan will always have to run parallel in your mind. We study interest rate derivatives, meaning a derivative contract with interest rate as underlying asset. But interest rate doesn't have any meaning alone. For instance, if I say interest rate is 10%. Now 10% of what? What is it for? So an interest rate alone has no meaning. What is necessary to have with it? Loan. So the term loan will always run parallel with us in this chapter. This chapter cannot exist without a loan. In equity derivatives, we could just say the price of a Reliance share. So we didn't need a second or third party there. But here, with interest rates, one thing will always be present, which is a loan. Without a loan, the interest rate is useless. So the word loan will always be with us and the entire calculation will proceed accordingly. We will understand its working now. What exactly is a fixed interest rate? Let's say I go to a bank seeking a loan. I tell the banker I specifically need 10 lakh rupees for 5 years and then he provides me with two distinct offers. Will you take it at a fixed interest rate or a floating interest rate? Does this happen? Yes, it does. You can check in real life. If you take a loan, the banker will ask if you want it at a fixed or floating rate. So what does this precisely mean for us? A fixed interest rate is an interest rate that will effectively remain the same throughout the entire tenure of the loan, for the complete life of the loan. Suppose the banker quoted an interest rate of 10%. If the fixed interest rate is 10%, then I have to pay 10% per annum interest. If it's a 5-year loan, it will be 10% per annum for 5 years. Then it doesn't matter what the interest rate is in the market. My interest rate is fixed. The bankers quoted fixed rate, 8%, 10% or 12% varies. These concepts, though basic, can surprisingly raise some doubts. The second thing is a floating interest rate. I told the banker that I want a loan at a floating interest rate, so please tell me what a floating interest rate is. Floating, you will understand from its name. It means an interest rate that floats, changes and is a variable rate. It will keep changing from time to time. It will keep changing from time to time. This means the interest rate won't remain the same during the loan's tenure and it will keep changing from time to time. Alright? What does this mean? For instance, I will give you a precise example now. I went to the bank and said I need a loan for 2 years. A loan for 2 years. So now tell me how you will give it at a floating interest rate. Does this mean that the interest rate for the 2 years will change daily? The market interest rate can change daily. So for today, suppose that today's interest rate is 10%. So will I pay today's interest at 10%? Tomorrow, let's say the market rate will be 10.1%. So will I pay interest at 10.1%? The day after, suppose the market rate becomes 9.5%. So will I pay at that rate? Then the next day it's 9.8%. So will I pay at that rate? Does this mean interest will be paid at daily market interest rate in floating? That's not how it works. The banker would go crazy calculating your interest daily because they actually have thousands of customers. It doesn't work like that. In a floating interest rate, the rate will change, it will vary. The interest rate will change during the loan. But a fixed time period will be decided, okay? And whatever the market interest rate is at that time, it will be applied to the loan for that period, alright? What is that? Let me show you how it works with the example I explained in class. Please take a look at this. See, what was the actual working then? I had drawn a timeline. Our loan is for 2 years. See, my loan is for 2 years. So for these 2 years, I sat down and decided with the banker. So for 2 years, what did I decide with the banker? Look here. So when will my floating interest change? Okay. When will my floating interest change in the market? I decided that with him. So when will my floating interest change? We decided on a reset period of 6 months. A 6-month reset period is what we call the reset period. This determines the exact interval when the floating interest rate will be adjusted and your loan's interest rate will then be set according to the market rate. I agreed on a 6-month reset period with the banker, and now what happens? Suppose I have taken a 10 lakh loan for 2 years. I drew the number of 6 months period in 2 years on the timeline. The first 6th month, end of 12th month, end of 18th month, and finally end of 24th month. Clear? So what happens now? At time 0, suppose the market interest rate is 10% when I am taking the loan. When will the first interest be paid? As the period is 6 months, payments are due every 6 months and the first will be at the end of the 6th month at 10%. At time 0, the market rate was 10%, so it will be paid at this rate, and that's first interest payment. After this, the second interest will be paid at the end of 12th month at the rate that was at the end of 6th month, because this time it's floating interest rate, for which we said the reset period is 6 months, meaning whatever the market interest rate is at the end of the 6th month, that will now apply for the next 6 months. At the end of 12th month, the interest rate was this. 6 months passed, our reset period is 6 months, so interest rate is reset according to market. At the 12th month end, this was the market rate. So now what rate applies to the next 6 months interest? 9.5%. At the end of the 18th month, this will be the rate. So from here until the 24th month, that is the interest for the period ending at 6 months, will be paid at the rate of 11%. There is no roll of the interest rate at the end of the 24th month because the loan is over now. But if loan were to continue, then this rate would have a role in paying future interest. Did you get it? Just keep this simple point in mind. In the case of a floating interest rate, a recent period will be decided. Interest rate today, suppose recent period is 6 months, the interest for next 6 months will be at today's rate. Then the market rate at 6 months will determine the next 6 months interest. The market interest rate then determines the next 6 months interest, and this process continues per reset period. Is the reset period always 6 months? Reset period can be of any duration. The bank and the customer will decide it mutually. It can also be for 3 months, meaning we will reset every 3 months. Just understand the name, it means the interest rate is being reset. If you want to calculate the interest, look, it's 10 lakh. Now sir, this interest rate that you mentioned, the reset period is 6 months. So are these interest rates of 10%, 9% for 6 months? No. If nothing is specified, the interest rate is always per annum. I have taught you this since the basics of AFM. Do not mistakenly assume it's a 6-month rate. Interest will be charged for 6 months, but the rate is per annum. See, the time for which interest is charged is a different thing, and the interest rate being per annum is a different thing. Don't mix the two. This is why basic concepts start to feel tough for you. These two work separately. So was any interest paid at time 0? No. You know, some people ask that why wasn't interest paid at time 0? You've just taken the loan and naturally interest isn't paid today. When is the first interest to be paid? At the end of 6 months at 10%. So 10% of 10 lakh into 6 by 12 for 6 months will be the amount. When will the second interest be paid? At the 12th month end. At which rate? 9%, as that was the rate at the end of 6th month, and interest for this period will be paid at this rate. So now we will calculate on 10 lakh at 9%. 90,000 into 6 by 12, which means 45,000. Similarly, interest will be paid at 9.5% here and at 11% here. I hope you have understood this point. We will keep understanding more as we go, and it's already been explained to you in detail in the class. So this is a floating interest rate. This means the interest rate will vary. It will change according to a benchmark rate. What is a benchmark rate? The market interest rate is also called a benchmark rate. On every reset date, the benchmark rate, which you should clearly understand is simply the prevailing market interest rate, will be applied. It is set to the market interest rate. On every reset date, the market interest rate will be applied for the upcoming period. What does a reset date mean? It's the date when the interest rate will be revised for the upcoming period. It will be revised to the benchmark rate for the upcoming period. In the bracket for benchmark rate, I have written BPLR, MIBOR, LIBOR. These are benchmark rates and are the market interest rate. They have been named. See, where does the market interest rate come from? The banks themselves issue the market interest rates on a daily basis. You must understand that the bankers actually have their own dedicated committees, and those committees then systematically issue the market interest rate on a daily basis. Okay, so there are many groups of banks in the market. So each group issues its own market interest rate daily, and there are variations among them. So which market interest rate should be taken? That's why the benchmark rate's name is in the contract, and these names can be anything like BPLR, which is Bank Prime Lending Rate. MIBOR is Mumbai Interbank Offer Rate. It's a group of some banks in Mumbai. They issue it daily. Similarly, LIBOR is the London Interbank Offer Rate. It's a group of some banks in London that issue it daily. It can be anything. Take whatever benchmark rate is in the question. Just understand this much about them. Don't get into too much detail. You only need to understand this much. So you have to keep this in mind. And as I mentioned, LIBOR is discontinued in practical life, but institute is stubborn and still gives it in questions. It's still used. Anyone with practical knowledge might ask what I'm teaching. I'm teaching according to institute's curriculum. See, example, a loan for 2 years at 6 months LIBOR. 6 months LIBOR means a 6-month reset period. I created a 2-year timeline with 6-month intervals, and 6 months LIBOR applies on every reset date. Payment at due date. It's written as 6 months LIBOR. So is that interest rate for 6 months? No, the interest rate is per annum, but the interest for reset period has to be charged for 6 months. Understood? Remember this much as we discussed it during basics. Here we have understood it in more detail. The question might state the interest rate as LIBOR plus 3%. This could be LIBOR plus 5%, LIBOR plus 1%, LIBOR plus 0.5%. So what should we make of this? You see, this is a mixed interest rate, which means the banker informs the customer that for floating rates, the prevailing market rate will apply. I will also charge a fixed component. For example, if he said LIBOR plus 3%, that means if the current market interest rate is 10%, then at the end of the first period, do you know how much the customer will pay? 10 plus 3. The banker quoted LIBOR plus 3, which makes it 13%. Here, if the market LIBOR becomes 9%, how much interest will be paid from here to here? 9 plus 3, so that's 12%. The meaning is clear. It can be anything, plus 3, plus 5, plus 1, or plus 0.5. It can be anything. That's why I wrote 2 examples here. You have understood this. The fixed interest component means the interest rate quoted to the customer is a mix of floating and fixed. Basic part for this chapter is completed. Now let's move to the second part of this chapter, FRA, forward rate agreements. I explained the basic concepts understood in class. Second part is forward rate agreements, FRA. Now our interest rate derivative part is starting. So now you should recall all the things I explained in the derivatives chapter. Make sure you have revised it. Those who are directly referring to this chapter through this revision, who haven't watched the full regular batch or haven't heard or done anything, if you're attending this revision, first listen to the derivatives revision you received. So refer to that first, then come to this chapter. Don't try to be over smart by trying to do this chapter first because it's short. Some topics have a sequence, and I always teach in a sequence in class, linking everything to proceed in a structured manner. We don't just do things out of order. You have to understand and proceed in a very structured way. Only then will things seem easy to you. Studying without a proper structure makes even simple things quite tough. Remember, this chapter directly links to derivatives. If you haven't truly understood derivatives, then this chapter will be the world's toughest for you, as its base is just not clear. So it's all derivatives. So understand that feeling. Let those logics settle in your heart again. What is it? A contract that we make today to carry out a transaction on a future date. Or if we want to bet on something's price in the future, the contract that is made for that, I have explained that to you in a short summarized way, and you must now revise the derivatives chapter. So in a derivative contract, there were 4 types of derivative contracts. Try to recall for a moment the nature of a derivative contract. A derivative contract, suppose the underlying asset is now an interest rate, so this becomes an interest rate derivative. But even this can be of 4 types, any derivative contract. Forward, future, option, and swaps. If you remember, we studied equity derivatives in the same way in the derivatives chapter. Similarly, in interest rate derivatives, same 4 natures are possible: forward contract, future contract, option contract, and swap contract. So you have to study all 4, but they are easy and not too time consuming. First, we will study the forward contract. The forward contract of interest rate derivatives. Now clear your mind of all equity derivatives and things like that. Don't start thinking about the price of equity shares as the underlying asset. The interest rate should be in your mind as the basic concept, and feeling are the same as the derivatives chapter. The underlying is interest rate. Therefore, you must set your mindset accordingly to understand this chapter. We will discuss the forward contract for interest rate derivatives. Sir, you are teaching the forward contract of interest rate derivatives, but we have a quick doubt. Please clarify it for us. When you taught equity derivatives in the derivatives chapter, you taught forward and future contracts together. You are saying we will study forwards first, then futures separately. So why this discrimination? In that chapter, I said forwards and futures are the same. There's a reason for that. For equity derivatives, underlying assets were equity shares, and their forward contracts are not available legally or regulatorily in the market. Future contracts for equity shares trade on the stock exchange, but their forward contracts are not available in the market in a legalized regulatory manner. That's something I might do with my friend while sitting with him. We will bet on this share's future price movement. I can do that at home, which means there is nothing separate for a forward contract. It is studied with futures as the crux is the same and there is no other difference. But for interest rate derivatives, when we are talking about this specific chapter, Forward contract in this chapter for interest rate derivatives is actually available in practical life in a legal regulatory manner. The government has made it available in the market for all of you. Okay. Forward contracts are over the counter. So the over the counter forward contract for an interest rate derivative can be done with a bank. You can go to any bank and tell them you want to do a forward contract for an interest rate derivative, and then they will help you with it. It is available in a legal regulatory way. So we have to study it separately. That's what we will do here. The core will be the same. The calculations, logic for forward and future contracts will remain the same, but we must study it separately. I told you the reason. The rest of the details are for the regular batch. So look here. Its actual name was forward rate agreement, which we call FRA in short, interest rate derivative forward contract. Why is it named forward rate agreement like this? Instead of forward contract interest rate derivatives, this name explains itself. Forward rate agreement. The rate signifies the interest rate. It's a forward agreement, meaning a contract for an interest rate. Interest rate. Sorry, a forward contract for an interest rate, which we call as forward rate agreement, and we call it FRA in short. So the name should clearly indicate that this is an interest rate derivative. This is an interest rate forward contract. Now to understand its meaning, the meaning of FRA is quite similar to what we have already covered in our derivatives chapter. What are we doing? Here we are making a contract with the bank. This is done directly with the bank over the counter, meaning the parties meet face to face. The bank is our legally available counterparty, and this is the FRA contract. Now you should go to the bank and enter into a formal contract for betting on interest rates for a loan of certain maturity after a specified period. You are betting on the interest rate, which means you are actually making a bet or a wager on its future movement. So sir, only betting? That contract was for buy, sell and physical delivery settlement. And look, we do not need to go into much detail now. I told you that even in settlement by delivery, we do cash settlement in practical life, and we do the same for question solving purposes. Ultimately, it's just betting in that too, being professionally written as a contract to buy or a contract to sell. We just need to bet. This has been explained thoroughly in the derivatives chapter, so we won't need to detail it here. Here we have to proceed with cash settlement. So we are directly starting from the betting point that it's a contract for betting. That's what should come to your mind. Now, how does the betting truly work here? It's very simple. Try to understand this. Look here. Mr. A is a particular person and he proceeds to go and talk with the banker because he is visiting the bank. Now, what exactly does he tell the bank? He says, look, I anticipate that 6 months from today, so the market interest rate will go above 10% in the future. 6 months from today, the market interest rate will go above 10%. Mr. A told the banker. This means he made an upside bet, a bet where he expected the interest rate to clearly rise. So see what occurred after 6 months? The market interest rate became 12%. So did Mr. A win or lose this bet? This wager that Mr. A placed with the bank, don't talk about gain or loss, just tell me if he won or lost. The bet was that interest rate would rise. It rose today, so he won the bet. And since he won, then it means I made a gain. If I win a bet, I get money. And if I lose the bet, I lose money. He won the bet means a gain. How much was the gain? By how much did I win the bet? It will go above 10%. So how much higher did it go? Today it became 12%. This means I gained 2%. I gained, that's basic concept. This is what we did in equity derivatives. We spent much time on this, and here we quickly look at the crux. Because we have studied it in detail, I said to revise that first, otherwise this will all go over your head. I won't talk in much detail here. Understood? Everything is same in logic. We used to say that Reliance's share will go above 2500. Suppose I took that bet. If it went to 2600 on maturity, I would get a gain of 100 rupees. It's the same here. I am just betting on the interest rate. There's nothing else to it. I'm just making a bet on the interest rate. Everyone understood, and it's done. A bet was placed on the interest rate. We found the gain, but this 2%. What is a 2% gain? Sir, the gain should be in terms of amount. Only then will I receive it. How will the other party really give me 2%? The gain or loss needs to be in terms of an amount. If I have a loss or a gain, whatever it is, if it's not in terms of an amount, then how else can the cash settlement happen between us? Do you understand this? If you think about it, we need this gain or loss in terms of an amount. That's why in interest rate derivative contracts, one crucial concept always accompanies the interest rate, and that key element is undoubtedly a loan. A loan will always be part of it. A fixed loan amount will also be mentioned in the contract, and the duration of the loan will also be mentioned. On what should we apply the interest rate? For that, a loan will be specified that for a loan of this amount for this duration, this will be the interest rate on it. For example, now I will modify the example slightly. What did I tell the banker exactly? After 6 months from today, the interest rate for a 3-month loan of 10 lakh rupees in the market will go above 10%. Listen to my wording. I have only changed this much. 6 months from today, the interest rate will go above 10%. I am saying the same thing here. I just added a simple thing that 6 months from today, the interest rate will go above 10% for a 3-month loan of 10 lakh rupees. For a 3-month loan of 10 lakh rupees, the market interest rate will definitely go above 10%, so that we can calculate the gain or loss. That's why you should always remember, in interest rate derivatives, the bet is placed on the interest rate. But the contract will always specify the loan amount and its maturity. It will be written in the contract at time 0. Otherwise, calculating the gain or loss is not possible without it. Understood? So I just said this much. Now it's very easy. Now the calculation is very simple. I said after 6 months, if someone wants to take a 3-month loan in the market, its interest rate will go above 10%. So after 6 months, the market rate became 12%. For the 3-month 10 lakh rupees loan, I said the rate will go above 10%. It became 12%, so I benefited by 2%. Now I have a 2% benefit on the interest rate. So on what amount will it be applied? On the loan amount. 2% of 10 lakh. That's it. What is interest rate? It's always per annum. So I have 2% per annum benefit on interest rate. But we were talking about a 3-month loan, and we were simply betting on a 3-month loan. So into 3 by 12. This means you have a gain of 5,000. Understood? I have taught you the entire forward contract. This is ultimately what you had to learn in FRA to calculate gain loss. It's an easy topic and people find it tough, thinking FRA is some strange thing. It's not. You have to understand the feeling. This chapter is all about feeling and nothing else. It's about feeling and logic, nothing special in derivatives. This is what's written. It is a contract with a bank for betting on the interest rate after a specified period. I left out a word in between, but I will explain why. What did I do? I made a contract with the bank to bet on the interest rate after a specified period like 6 months. Point was covered up to here. But in this, we were not able to settle in cash on maturity, and I couldn't understand the amount of gain or loss. So for this, another important aspect was added to the contract. The interest rate you are betting on will be for a loan of a certain maturity. For a loan of a certain maturity, meaning it is a contract with the bank for betting on the interest rate. For a loan of a certain maturity, which means 6 months from now. So the interest rate for a 3-month loan of 10 lakh rupees has actually gone above 10%. This point gets added. You just have to think according to the interest rate. The concepts are like those in derivatives. You just have to think in terms of interest rates. This chapter really needs thinking, because memorizing it without logic only from notes may secure marks but won't give confidence. But you will never gain confidence in this chapter. Now let's move on. Look, it's normal, it's simple. I have explained cash settlement, but I can also explain it to you in a normal way. The way you would typically do physical delivery settlement. I could have also told the banker that after a 6 months period, I will take a loan of 3 months of 10 lakh rupees from you at 10%. So after a full period of 6 months from now, I will take a loan of 10 lakh rupees. For 3 months, I will take from you at 10%. I can also make this contract. This is also my upside betting contract, an upside betting contract. I'm talking about taking a loan. Why? At time 0, I anticipate needing a 10 lakh rupees loan in 6 months. I need a 10 lakh rupees loan for 3 months. My fear is, if market rates rise significantly in 6 months, I will then be compelled to get it at that higher rate. So you said there's no solution, you will simply get the loan. But I'm afraid the interest rate will rise in the market. So you gave me suggestion to take loan today. I am not foolish to take a loan today and keep it, since I only need the loan after 6 months. I would then pay unnecessary interest for 6 months just because I fear the interest rate will rise. There's just one solution for this. Enter into a derivative contract and hedge yourself. The main focus of this chapter is hedging, so I'm explaining that as well. You can think this way too. I can say that in reality only cash settlement occurs, and we will discuss this because exam questions also follow that manner. Let me explain it. Ultimately, crux will be same. Let's verify. I also verified in class. I can tell the bank I am afraid of rising interest rates. I can make a contract today to take a loan from you at 10%. Then if market rates rise, I won't have a problem. This is an upside betting contract, which we call a contract to buy. In professional language, contract to buy, contract to sell, contract to buy means upside betting, while contract to sell means downside betting. Remember from the derivatives chapter, that's what is written next. If as per our expectations, now if we have an expectation, a feeling, a fear or a feeling that the interest rate will truly rise in the future, then what should we immediately do in an FRA? We should consider upside betting. If I feel the interest rate will rise in the future, I should do upside betting, as it means a contract to buy. In derivatives, a contract to buy signifies upside betting. To buy FRA. Similarly, if I feel the interest rate is going to fall in the future, then I will simply place a downside bet on that movement. I will bet on that, meaning I will place a downside bet on the interest rate. A downside bet means a contract to sell, which means selling an FRA. If the question uses the technical term buy FRA, don't panic. We are doing upside baiting. I taught this basic concept in derivatives. I revised it here again. If anyone still has a doubt in this, then you haven't understood derivatives at all or you haven't studied it. It's an easy chapter about feeling. You don't have to do anything. You just have to bet on what you are afraid of. As I told you, there's a movie song, whatever I'm afraid of, I'll do just that. So you have to do the same. Now you don't need to think about the context of that song anymore, and please don't play that song with the video. Just focus here or you will get distracted. Let's move on. Look at the example now. What I just told you is written in this example. A bank is offering an FRA for a loan of 3 months after 6 months from now at 10% per annum. A bank is offering an FRA, specifically a 3-month loan. 6 months from today, it's offering an FRA on a 3-month loan at what rate? 10% per annum. The example I was just giving is written here in question format. We call this a 6/9 FRA. You can see it in the brackets. I will explain this. Ignore it for a moment. If we anticipate that the interest rate will indeed rise after 6 months, we will enter a contract to buy an FRA at 10%, meaning an upside bet. And if we feel interest rate will fall, then we will sell FRA, meaning we will make a downside bet on 10%. Understood? It's a simple concept. And now understand the FRA quotation I wrote in the bracket above, 6/9 FRA. I was giving you the example like after 6 months for a 3-month loan on the interest rate. So what did that mean? We call that an FRA quotation. 6/9 FRA. Now what does this mean? It means an FRA for a loan of 3 months after 6 months from now. There are some FRA quotations used in practical life. For example, if you see 6/9 FRA written in front, it's 6/9 FRA. What does this mean? Look, the multiplication sign here is read as by, by by. It's a 6/9 FRA. In practical life, the bank quotes it to you like this. So if you see it in the exam, don't panic. These are normal things, just understand them for once. I'm telling you this so you don't panic seeing the question and understand it. This means after 6 months from today. The first 6 means 6 months from today from the 6-month period's end. 6 months later, 6 months from today. We are placing a bet 6 months from today. On what? For a 3-month loan. What's the gap between 6 and 9? This covers the period from 6 months until the end of the 9th month. 6th month end to the 9th month end loan is for 3 months. This effectively means we are betting on a 3-month loan that will start 6 months from today. The loan will start 6 months from now and it will continue until the 9th month from today. Counting from the 6-month mark, it is a 3-month period. A bet is being placed for a 3-month loan starting 6 months from today. You will get it. It's very simple. The gap between these two indicates the loan's duration and the initial 6 reflects the bets start 6 months from today. So sometimes a question might state that we have purchased a 6/9 FRA at 10%. You might then think, what exactly is this all about? I explained upside, downside and betting in a normal way. But in the exam, it appears like this. It's simple. Go through the basics. So I bought an FRA at 10%. First, look at this. And to buy an FRA means you have placed an upside bet at 10%. Now what does 6/9 mean? It means that 6 months from now, the interest rate will go above 10% for what? For a 3-month loan. The same thing can be written this concisely in a question. You need to know how to interpret it. Similarly, a 3/9 FRA. So this actually means a 6-month loan 3 months from today. What is the gap between 3 and 9? 6. So after 3 months, 6 months loan. Similarly, look what I have written here. A 3/6 FRA. An agreement for a 3-month loan 3 months from today. First 3 reflecting 3 months from today. The gap between 3 and 6 equals 3 months, meaning betting on a 3-month loan 3 months from now. This time it says 2v3 FRA. So what is the significant difference when V replaces X? It means reflecting years, but rest of the interpretation is same. We were talking about months. So what does it become? This means after 2 years from today, there will be a 1-year loan. A 1-year loan 2 years from today. The gap between 2 and 3 is 1. If there's a multiplication sign here and X signifies a 1-month loan 2 months from now. If a V sign appears in middle, what will you say instead of months? Years. We are betting on a 1-year loan 2 years from now. 2 years from today, we are placing a bet on the 1-year loan's interest. It's that simple. You have to understand these interpretations. After this, you should know about the interpretation of FRA rates. Sometimes 2 rates can be given in a single question. Okay? A minor point, but you should still be aware of it. Take a close look. What is this? It's a 6/9 FRA. Suppose you are given this, a 6/9 FRA. You went to the bank. You went to the bank and you said you want to enter into an FRA for a 3-month loan 6 months from now. Then they will give you a quotation for a 6/9 FRA like a menu card in a restaurant. The item on menu card is a 6/9 FRA. Opposite is price. You can see 2 prices, 9% and 10%. Which one do I bet on? Can I just pick any one? What does this mean? No, it is not like that. The bet will be placed on only one of these two percentages. Then why is the banker giving two different rates? Why two percentages? Understand its logic. If you want to make an upside bet, meaning if you want to buy an FRA, then it will indeed be at the higher rate. Always remember this important fact, the high rate. If I make a contract for an upside bet, it will be at 10%, end of story. Remember this. And if I want to make a contract for a downside bet, meaning to sell an FRA, it will be at 9%. So it will be at 9%, that's all. An upside betting contract will be at 10% and a downside betting contract at 9%. More logic exists as explained in class, which I'll briefly review now. Look, an upside bet means a contract to buy and a downside bet means a contract to sell. So when we go to a bank as a customer, it's just like when you go to any shopkeeper as a customer. The customer is always in an adverse situation. When a customer buys from a shopkeeper, the price is higher, and when they sell to the shopkeeper, the price is lower. On buying expensive rate applies, on selling cheaper one. You can understand this in another way. This FRA rate is actually used for taking a loan. I said I will take a 3-month loan. 6 months from now, what is the rate? Or I will make an investment for 3 months, 6 months from now. I had given another interpretation for this earlier. We are afraid the interest rate will fall in the future. When would that fear arise? Let's say I have to make an investment 6 months from now because I will receive some money for 3 months and I have to invest it. I will be afraid of interest rates falling, not rising. So I will make a downside bet. Can I then enter an FRA contract for that purpose? Yes, I can enter an FRA. This means one can be an investor or they can be a borrower. So if you go to a bank today, just forget about FRAs for a moment. You tell the bank you need a loan. The bank says 10% interest. I say I want to give you a loan, meaning I want to invest money in the bank. The bank will say 7%. You know this. Whenever you take a loan from a bank, the bank charges a higher rate, but when you deposit money in a bank, you get a lower rate. It's the same thing here. When does the 10% rate apply? It's because I'm making an upside bet for when I go to take a loan. I will take a loan as a borrower. Let's say in the future, I need to take a loan from the bank. Afraid of interest rates rising means I have to make an upside bet. Borrowers make an upside bet, so the higher rate is applied to them. And if I'm worried about the future, that I have to invest money 6 months from now, then I will be worried about the interest rate falling. So I will make a downside bet. So an investor is the one who needs to make a downside bet. So for the investor, the lower interest rate will be applied. So the lower rate is for a downside bet. I have told you some of the main logics. Just remember this, it is a minor point. Lower rates are for selling an FRA, a downside bet. Higher rate is for buying an FRA, meaning an upside bet. Just remember this point. Now here, the final FRA settlement has already been explained because you have studied it. I have made an FRA contract with the bank, placing a bet on a 3-month loan 6 months from now. I said that for a 10 lakh loan for 3 months, the interest will go above 10% after 6 months. Now we need to settle this, meaning the profit or loss. The final settlement of an FRA has a formula to calculate the amount of profit or loss. So we'll put in the amount. As learned in derivatives, profit or loss is not evident from the calculated amount alone. You must determine it using a chart and logic. So yes, I have already taught you how to calculate the amount. I will teach it again using this formula. Understand the amount calculated at maturity. First, judge whether you made a profit or a loss. When you do the cash settlement, did you make a profit or a loss? You have to judge that. It's actually very simple. Initially, I had a contract to buy an FRA, meaning I made an upside bet. At maturity, if the market interest rate has increased, when the market rate exceeds the agreed FRA rate, I have won, and that is a profit. RR means reference rate or market interest rate. We will look at this. The market interest rate is RR or the reference rate. FR means the rate mentioned in the forward rate agreement. FR is the forward rate, the contract rate within the FRA, which was 10% in our example. If the market interest rate at maturity is higher and the contract rate was lower, it's an upside bet profit. If the market interest rate fell and contract rate was higher, then I lost. Similarly, if I had sold an FRA, a downside bet, and at maturity the market interest rate went up and the FRA rate was lower, that means I lost. And what if the market rate went down? And if the FRA rate I contracted was higher, I won since I had a downside bet. It's simple, the same logic, nothing really special. How we will calculate the amount afterwards, we have a formula for that. So do we have to memorize it? It's not a formula, but a basic concept you've learned since childhood. Look at the formula, you'll automatically remember. I just did the calculation, look. 6 months from today, for a 3-month loan. So I made a full 9-month timeline. So 6 months from today, look, 6 months from today. 6 months from today, we're talking about a 3-month loan. So for that 3-month duration loan of 10 lakh rupees, we are betting that the interest rate will go above 10% within the FRA. The FR rate or the contracted rate, it is 10% and we have made an upside bet. At the end of 6 months, we will know whether we have won or lost the bet. On that day, the market interest rate is 12% and we call this the RR, reference rate. I had an upside bet, so I won and I got a benefit of 2%. The bank will pay me 2% of what? 2% of 10 lakh for a 3-month loan, so 3 by 12. You know the settlement. But look, I'll show you how to calculate it logically. Setting aside cash settlement, let's think. After 6 months, I needed a loan for 3 months until the 9th month. If I hadn't done this FRA, hadn't made this contract, then on that day's market interest rate, when I say that day, I mean the end of the 6th month when I needed the loan. So I would have taken at 12%. Whatever the market interest rate was, if I had no contract, I would pay 12% on 10 lakh for 3 months, meaning 30,000 in interest at maturity. Understood? But because of the FRA contract, if I expect a physical delivery settlement and contact the bank to take a loan from them after 6 months for 3 months at a 10% rate, so I got the 10 lakh loan at 10%. The interest for 3 months, meaning I had to pay 25,000 in interest. With this contract, I paid 25,000 in interest. Otherwise, I would have paid 30,000, resulting in a 5,000 gain. Now it's visible in cash settlement. 5,000 gain is visible, settlement occurs. We had a contract for a 10 lakh loan. The rate became 12%, we bet on 10% and upside bet, so a 2% gain. We bet on a 3-month loan, meaning a 5,000 gain. The same amount came out. So this is your gain happened in FRA. Is this the final gain or loss then? Yes, it is. But there's a small twist that our institute also adds logically for this topic. Generally, the institute doesn't do this, but it does for this topic, so we also have to pay attention. Let's see how and why this happens in practical life. I'll give you a little reason. Look here. Practically, I would have taken the loan at the market rate or the FRA rate. The loan interest settles at the 9th month's end, 3 months after the 6th, as interest is paid upon loan completion. When taking a loan, I don't pay the interest at the end of the 6th month. So this gain of 5,000, where should it occur? This gain is occurring at the end of the 9th month. This gain of 5,000 is happening to me at the end of the 9th month. Actually, if I go the physical delivery route, I see a gain of 5,000 at the end of the 9th month. But with the banker, since I know the market interest rate at the end of the 6th month, I can do a cash settlement directly here. And in practical life, the cash settlement is done right here. End of 6th month, the settlement is done here. I will tell the banker market rate is 12%. It's clear that I have a 2% benefit. Okay. I mean, it really makes no sense to wait until the loan's maturity and then actually take the loan to calculate the financial gain. We can settle it in cash here. This reality is discussed with the banker. Cash settlement. In reality, loan are taken at market rate. But for the FRA I entered, I will do a cash settlement. So ultimately for me, the interest cost ends up being the same. I can verify that. So cash settlement happens here. When does the gain occur? At the 9th month's end, but cash settlement at the 6th month's end. You have to pull it back by 3 months and bring it back using present value PV. It's simple. This gain of 5,000, you have to calculate its present value. How is PV done? Simple. Now what will the banker say? He'll be like, your gain is due at the end of the 9th month. Today is the end of the 6th month, meaning 3 months from now. Now you are asking for it today, so I will not give you the full 5,000. Think about it. If I give you the money today, you could invest it somewhere at the market interest rate, earn a return on it. That's simple. Today I will give you money deducting market interest because your gain is actually recognized from the end of the 9th month. So I have the right to give you this money at the very end of the 9th month because the gain is from the end of the 9th month. This means I can also invest it somewhere as a bank for 3 months. If I were to give you the money today, I would face an opportunity loss as the market rate is 12%. How do we calculate PV? With the market interest rate, because this money will now be invested at the market interest rate. So a gain of 5,000 rupees. This gain is at the end of the 9th and this at end of 6th month. So the gain is 3 months away. So bringing back for 3 months with PV, it's 1 plus R. This is the way to do PV. What is R? 12% market interest rate. R is the reference rate. But here, we do not have to pull it back for a full 12 months, but only for 3 months, specifically from the end of the 9th month to the end of the 6th month. Where do we have to pull it back? You should know the basics of PV. I taught the concept of PV in the basics of AFM. If you don't know, you won't understand PV. We are not bringing it here using PV. We are here for settlement. What is the gap between here and there? 3 months. We need to take the PV for 3 months. Let's use the PV formula. 4854. 4,854 invested at 12% for 3 months becomes 5,000. So 4854 is exactly the final cash settlement that I will get from the bank today. Got it? So in this way, the FRA topic is now complete. This is the only formula. Now in practical life, an FRA is usually cash settled. Now if I actually needed a loan today, I would take it at the market interest rate. Then what was the benefit of the FRA? Look here. If taken at market rate, I'll pay 30,000 interest after 3 months. Since I had the FRA, I gained 4854 today. So investing this in the market will show a 5,000 benefit after 3 months. 30,000 minus 5,000 is 25,000. So it's the FRA rate or not? Whether cash or physical settlement, the outcome is the same. In practical life and exams, we do cash settlement. Actually, loan will be taken at the market rate. But in the FRA that you will do, the gain or loss will be cash settled. These are practical life matters. Now let's move on. Don't overthink this. Look at the formula for the final settlement amount. N stands for the notional principal amount. This is the amount for which you made the contract. The loan amount is the notional principal. It's a cash settlement. You don't actually take the loan, so you can do it for any amount. Into RR minus FR, the market interest rate minus the contracted rate. That's the difference we were taking. Multiply by time of loan. The FRA loan period, then divided by 365 or 12. By 1 plus RR, meaning we have to PV it using market rate but multiplied by time. For what period? What was the duration of this loan? You had to bring it back using PV according to that. So this formula for gain and loss has now been explained. Now the next topic in FRA is the theoretical or fair FRA rate, which is a completely useless topic, let me tell you. From exam point of view, it's literally total garbage. And it's not even part of the syllabus. A question on it appeared a very long time ago, which is not even in the module. I have explained it just because of that. Otherwise, it is of no use. You can skip it, but take a quick look. It is my responsibility to teach. I have taught this in detail in class, and now I'll briefly explain. We enter into an FRA. I told the bank that for the 3-month loan, 6 months from now, we are betting that the rate will go above 10%. We mutually decided on the contract. So where did that 10% interest rate come from? The rate we were betting on, how was that decided? In practical life, the bank itself decides the rate. The bet will be placed on whatever rate they quote, and they can state anything. In practical life, they can give any rate, that's a different matter. But theoretically, what should the fair rate be? And theoretically, what should the fair FRA rate actually be? Just like we used to study in equity derivatives, under the topic, the pricing of forwards and futures. What should the fair future price be? And similarly, here, what should the fair FRA rate be? Fair means a reasonable rate, so that no one is treated unfairly. Which means neither the customer nor the bank should face any problems. And what then should the theoretical fair rate be? The theoretical fair FRA rate is a rate at which the company remains indifferent between 2 short period borrowings and 1 full long period borrowing at once. So I repeat, I have written this according to my own concept. There are no fixed definitions for it. Let's have an example. I had already explained this with an example. I'm talking about a 3-month loan 6 months from today. 3-month loan 6 months from today. So I've drawn a timeline here. For a full 9 months, I put a 6-month period in the middle. A 3-month loan after 6 months with a timeline. Now if you look here, if we talk normally, let's say as a customer, I need a loan for 9 months. Let's say for example, I need a loan for a total of 9 months today. So I would go to the bank and ask, what interest rate will they charge me for this period? They stated an 11.50% per annum rate would be applied and then adjusted for 9 months. I asked, what if I need a 6-month loan from time 0? They quoted 12% annually. Why are interest rates different? This happens practically. And this interest rate is per annum. I'm not paying 12% for 6 and 11.5% for 9 months. This per annum rate will be adjusted. Why are these rates different? 6 months 12% annually, 9 months a different rate. This is a standard market rule which you'll find in practical life. I mean, if you go to a shopkeeper and say you need 1 pen, he'll say it costs 10 rupees. Now if I say I'll buy 100 pens from you, so for 100 pens, he quotes 9.5. If you give someone more business, they give you a discount. The bank is the same, it's a shopkeeper and you are its customer. The bank's income is from the interest on loans. If I take a 9-month loan, the bank quoted me an 11.5% interest rate. And if I take a 6-month loan, they quoted 12%. Why? Because their earnings are for 6 months interest and 9 months in the other. So here I'm giving the banker more business. That's why it gave me a discount on the interest rate, and this happens in practical life. You can go and check. This concept is complete. Now look, why am I talking about all this to calculate the theoretical fair forward rate? Because I said a fair rate means a reasonable rate so that no one suffers a loss. Now we are talking about a 3-month loan 6 months from today. What should be the theoretical fair value for a 6/9 FRA, which refers to a 3-month loan starting 6 months from today, and this is what the banker quotes. What will be the fair interest rate? Well, you know what this means for this 3-month loan. How much interest rate should the bank charge for this 3-month loan? How much should it charge? The banker should charge an amount that keeps the investor indifferent. The investor shouldn't be affected. The investor could either take a full 9-month borrowing all at once today, or he could take a 6-month borrowing now and then a 3-month borrowing later. The investor should not be affected overall. Overall, he should get the same rate as for the 9-month borrowing. So did you understand? Listen again. Look, as an investor, I feel that I need money today. Think about it for a moment, take forwards and all that out of your mind. Just think normally. I need money today, okay? And I am not sure if I will need the money for 6 months or for 9 months. I feel like maybe I won't need the money after 6 months. I only need it for 6 months and I will repay it after 6 months. But understand that there could also be a scenario where I might have to take a 9-month borrowing, and this would simply mean I might need a loan again later for 3 months. What if a future scenario? I am confused whether to take a loan for 6 or 9 months. So here, I go to the banker. Should I take a lump sum loan for 9 months, or should I take a loan for 6 months first, and then if I need it, take another loan for 3 months? So we are discussing the customer taking a loan for the entire 9-month period all at once, or taking the same loan in 2 parts, first for 6 months, then if needed for 3 months. So should he take it in 2 small parts or as one big loan at once? The customer should not be affected nor discriminated against. Ultimately, they should be charged the same rate applicable for the full long period loan. Ultimately, he should not be impacted. Such an interest rate, whatever that is, will be the fair forward rate for this period. For this useless topic, understand this. What is the logic for its calculation? There is no formula, it is illogical. So look, if I take a borrowing for the entire long period of 9 months at once, then how much interest and what will be the total amount repayable at maturity? Let's assume the principal is 1. What is the interest? At 11.5, it's 0.115 in decimals. This is per annum, so for 9 months, it's 9/12. So this will be my total repayable amount at maturity. Did you understand this? It's only when I take 9 months borrowing at once. But I want to take this loan in 2 distinct parts, first for 6 months, and then if I feel the need, for another 3 months. If I take a borrowing of 1 rupee for 6 months, 12% interest will be charged for 6 months. After 6 months, we'll repay this amount because I am sitting on a 6-month borrowing. This total amount will be repaid 1 plus interest. But suppose after 6 months, I need a loan for another 3 months because we want to match the loan of these 2 short periods with the loan of the large period. The single long period loan's repayment at maturity must then completely equal the combined total from 2 individual short period loans. After 6 months, this repayment will happen. But after 6 months, I will need another 3-month loan. So what should I do? This loan has to be repaid anyway, means this total amount. So I will have to borrow this much amount. That's why this amount is multiplied by 1, that I need this much, and now interest will be charged on this amount. Interest will be charged on this amount, so multiplied by 1 plus. Now for this, after 6 months, for the upcoming 3 months, we need to discover the fair FRA rate. How much time? 3/12 per annum rate. This will be the total repayment at maturity if I borrow in 2 short periods. Or should I borrow for 9 months at once? These 2 repayment amounts should be equal. The fair rate says this, so that no one is discriminated against. You can calculate R from this and a mathematical equation is formed. You have found your fair FRA rate, finishing this useless topic. Should I take the total 9-month loan all at once, or perhaps split it into 6 and then 3 months? Now if I solve this equation, 1 plus R 3/12. This is in multiplication, so it will go to the other side in division and become like this. Then I kept R 3/12 here. 1 went there as a minus, so this is my equation and I got 2.48%. This 2.48% is for 3 months after 6 months. It's the adjusted rate for those 3 months because 3/12 is kept multiplied with R. It's adjusted. To get it per annum, the 3/12 on the other side becomes 12/3, giving 9.92% per annum. So the FRA rate here, 9.92% per annum, this is what we call fair FRA rate. You should have understood, as it's simply basic mathematics, nothing else, right? It has been explained how to calculate it. What will be the theoretical fair FRA rate for the second short period? There is one large long period and within it 2 short periods. So how is the theoretical FRA rate for the second short period calculated? It's 1 plus the interest rate applicable for the full long period borrowing. Divide by 1 plus the interest rate for the first short borrowing minus 1. That's the formula. This equation, I have shortened it further. In this equation, if you notice, here are 3 by 12 the adjusted rate for that period's FRA. Adjusted not per annum, but adjusted. 1 plus the interest rate that's applicable for the long period. Divide by 1 plus interest rate for first short period minus 1. I created a formula from here and written it down, just in case it comes up in the exam. The answer is in decimals and multiplying by 100 yields the percentage, as our calculations use interest in decimals. I explained this in basic mathematics during the basics of AFM. So all the students in the class know this. That's it for now. This rate that comes will be for that particular period and will be per annum. It is adjusted. For example, a 3-month borrowing is available at 12% today. 6-month 11.5%. So tell me what should be the interest rate after 3 months. So the company remains indifferent when borrowing for 3 or for 6 months. Entire period is 6 months. First and second short period are 3 months each. So we'll find the theoretical rate of 3 by 6 FRA. So it's the same thing. 1 plus interest rate for the full long period borrowing divided by the first short period minus 1, and we multiplied by 12 by 3 to get it in per annum. Similarly, 2-year borrowing is at 4.2% and 3-year at 4.48%. So what should be the interest rate after 2 years? So that company remains indifferent between 2-year and 3-year borrowing, meaning theoretical rate of 2v3 FRA. So overall period is 3 years. The first period is 2 years and then 1 year. Now 1 plus, you will use the 4.48% rate for the 3-year period. But this is for 3 years and the rate is per annum. When it comes to years, you will use powers as the institute does. I have explained this now and you must remember it because I cannot do anything about it in the exam. That's why I took this example and raised power to 3. In the denominator, it is 1 plus 4.20% to the power of 2 for the 2-year period. Because the first small period is 2 years, minus 1, so this provides the 1-year rate. It's 2v3, so a 1-year loan after 2 years. Second period is 1 year, bringing the annual rate. Okay? Here in your mind, if you think too much, you might have one more doubt. That a 2-year loan is available at 4.2% and a 3-year loan at 4.48% per annum. The longer the loan period, the cheaper the rate. First of all, anything can happen in exam questions, and such a scenario is also practically possible. Long-term loan is available at higher rate due to the company's position. The company's credit rating is bad. The banker feels that if he gives a loan for a longer period, this company will run away with the money. Understood? Many factors depend on these things. Don't make an instant judgment. Practical life has many factors. This completes the entire topic of FRA for this chapter. Now in the third part of this chapter, we saw interest rate futures, which we call IRF in short. This is the future contract of interest rate derivatives, also known as IRF in short. Let's complete this quickly. This is a small part and it's very easy for the exam, but students never truly understand what is happening in it. So it's very easy for the exam. I'll show you the working, but I already explained that in detail for your better understanding, which is why students always get confused in this. They make mistakes with useless things, so I will explain that a little bit again here so that you are never afraid of it. Now you can see interest rate futures. So this will also be the same thing. Don't read anything here for now. Just focus on me. Listen to me. You have surely thought this. This is a future contract of interest rate derivatives. In this, the underlying asset is the interest rate and we are betting that it will go about 10% after 6 months. I'm betting on this, but the stock exchange must have come in between because it's a future contract. This is what you must be thinking, but it's not like that. In this interest rate future derivative contract, please remember that the underlying asset for the agreement is never the interest rate. In interest rate futures, the underlying asset is never the interest rate. Always keep this in your mind. This is the only such derivative contract. The very purpose of this derivative contract is not its underlying asset. Its name is interest rate future, though it appears an interest rate derivative. The underlying asset is not the interest rate. What kind of interest derivative is this? I will explain. Underlying asset is not the interest rate. I have already clarified this to you, and remember that the underlying asset in an interest rate future is never the interest rate. Due to this special provision, this topic gives everyone trouble. They don't understand it. Students think they are reading something else, so they get confused in this. Underlying asset is not interest. So tell me, how can we hedge our interest rate risk with interest rate derivatives? Why are we studying this topic under this heading? It's not an interest rate derivative if not underlying. So I will tell you that. Ultimately, the bet will be on the interest rate itself. I mean, the underlying asset in this is not the interest rate. I have made this contract with the stock exchange that I want to bet on some particular thing. In this, the bet will be on something other than the interest rate. I will tell you that in a while. The underlying asset and the bet will be on something else. Understand this carefully. But ultimately, you should understand that indirectly, your bet is on the interest rate itself. Indirectly, your bet is on interest rates. You will either gain or lose based on the change in the interest rate. That means you will not directly bet on the interest rate in an interest rate future. You might be betting on something else outwardly, yet inwardly something different is at play. Just like the ads that appear on your TV, the Vimal Pan Masala ones, which big stars advertise these days. The ads for Pan Masala from different companies come out quite often, like Kamla Pasand, Vimal, and many more. So they never advertise in the name of Pan Masala, and I will now tell you how they actually advertise. They actually never advertise their main product directly by using the name of tobacco itself. They advertise in the name of something that is completely normal, like cardamom. Alright, so they advertise in the name of cardamom like Vimal Ilaichi, if you read the fine print there. Nobody must have ever eaten their cardamom, and whoever sees that packet clearly knows what it ultimately is. If you remember, like there's another ad for Royal Stag or something, and let me tell you, I genuinely don't have much knowledge about these things. I avoid such things. So that Royal Stag ad, if you have ever watched it, I'm sure anyone watching that ad knows exactly what they are selling, and it's probably alcohol. I know you can tell just by watching it. Anyone can tell by watching the ad. But whenever they advertise, they write in small letters Royal Stag's water, advertising just water. Have you seen this company selling water? It's never in the market. You will not find anywhere. They just advertise in that name. These are called surrogate ads, in which you actually see something else in front of you, but you're ultimately aware of what's behind that surrogate ad. What you see is just for show, and the same thing happens in interest rate futures. Let's say a calculator is shown in front of you and you are asked to bet on it. This is just to show the world that the bet is on the calculator, but behind the scenes the bet is on the interest rate. Just understand this. You will grasp it if you look at it in simple terms. The underlying asset is not the interest rate, but the bet is indirectly on it. You won't tell the world that you are betting on the interest rate. I am betting on the interest rate through interest rate futures. You will say that you are betting on this particular asset, but ultimately you know that you are betting on the interest rate because of the past. This is an interest rate future contract. The bet is on the interest rate, but outwardly the underlying asset is something else. What is the underlying asset in an interest rate future to show the world? The underlying asset is bonds. You understand bonds, right? Bonds are the underlying asset in this. Zero coupon bonds or bonds that have a coupon. Bonds can be of two types in the market. Those bonds that have a coupon. You understand a coupon? A 7% coupon bond is 7% of the face value. Payments will be annually or half yearly as specified. A company raises money through bonds. It pays a coupon and redeems it at face value or whatever amount they mentioned at maturity. Can you tell me what are zero coupon bonds? A company issues them at a discount and redeems them at face value. So how is it explained? This has been taught in security valuation. If you study the chapters in sequence, you won't have any problem. We will not talk about bonds in detail. That's already been taught. So in interest rate futures, the underlying asset is bonds, but indirectly the bet is on the interest rate itself. In this, the underlying assets are bonds. Why are these assets solely bonds, and why is the bet indirectly on the interest rate? I will explain this in detail, but let's summarize it here as it was already explained in your regular batch. So let's take a quick summary here. First, you will think that if bonds are the underlying, then it should have been called a bond derivative, right? If equity shares were the underlying, we were calling it an equity derivative. So should we call this a bond derivative? No, interest rate derivative, because ultimately the bet is on the interest rate. Now, how will that bet be placed? Why and what is the reason? Let's talk about that now. First, why was the interest not made the underlying? Why is it hidden like this? Why are bonds made the underlying and not the interest rate when the bet is on the interest rate? You go to the stock exchange. Have you seen interest rates being traded? Now the interest rate is 8%, it's 8.1%, 8.2%, 7.8%. Share prices and other things fluctuate. Have you seen interest rates traded like this? No. Interest rates are never traded on any stock exchange because only those specific items with a defined price are traded there. Interest rate is never in terms of price, it's a percentage. If you trade on it, how will you settle the gain or loss? There they won't mention the loan amount or anything. So all of those stock exchange people themselves, if they were to trade on interest rates, they would start trading on them. But how would they settle the gain or loss? Meaning on the stock exchange, such a thing cannot be traded without price. Interest rate is not in terms of price, rather it's a percentage. So it is never directly traded on an exchange. Future contract available on the stock exchange, and it will never let you bet directly on interest rates. So suppose I need a loan for 3 months after 6 months, but I'm afraid that the market interest rate will go up. So you can do hedging. How do we hedge? Forward contract? No, I want an interest rate future. I went to the stock exchange to bet on the interest rate. The stock exchange refused allowing me to bet on interest rates. They asked me to go to the bank for FRA. I said no, I want to make a contract with you only. The stock exchange told me, look, I'll give you away. I have a contract where the underlying asset is a bond. The bond is the underlying asset, you bet on that. I asked how my interest risk would adjust. The exchange said, you are betting on the bond and your gain or loss ultimately comes from market interest rate changes. You will have that much of gain or loss in it because the bond has its own amount and it surely has its own price. Okay? Bonds have their own percentage rate and associated interest rate. I will explain how. Whatever fluctuation we have in the interest rate, that much will be your bet. Your work will also be done. So the underlying asset is a bond in an interest rate future. Now how it is, in what way it is, I will explain that to you. Now look, underlying assets are bonds with two types. Zero coupon bonds or bonds that have a coupon. We discuss interest rate futures where the underlying is a zero coupon bond. How are calculations done? Firstly, it's very easy talking from an exam point of view. This means you are betting on the price of a zero coupon bond. So it is a contract on stock exchange for betting on the price of a zero coupon bond on a specified future date at a prefixed price. It's a cash settlement and I will bet if the price of the zero coupon bond will go up or down in its market value after 6 months. I will place an upside or a downside bet. If I place an upside bet and the price goes up, then I win. And if it goes down, I lose. If I place a downside bet and the price goes down, I win. You already know how to calculate the amounts. Haven't we done this with shares before? For instance, if I bet the share price will go above 2500 in 3 months. If it went up, I won, and if it went down, I lost with an upside bet. With a downside bet, if it went down, I won. If it went up, I lost. The amount is the difference. It's the same process we have already learned for calculating gain or loss in equity derivatives, making it very easy for the exam. Simply observe the zero coupon bond price you bet on. Your gain or loss, whether an upside or downside bet, depends on its difference from maturity price. The process is identical. And exam wise, this is free marks. But now let me explain the underlying logic of how this impacts the interest rate. So to understand, look here. Zero coupon bonds generally have a face value of 100 in the market. Generally their face value is 100. For one bond, total value depends on the bond's quantity. So when company issues it, like I said, it does that at a discount. So at what discount will the company issue it? Alright, so today the company said the bond is for 100 rupees. You give me 90 rupees. This means the company issued it at a 10% discount. Give me 90 rupees. Let's say maturity is after 3 months, then after 3 months I'll give you 100. We'll redeem and give you back 100. It gets redeemed at face value. So it's a zero coupon bond as investor earned by giving 90, getting 100, which is a gain of 10. So for the company, 10 became the cost. So it's a cost that is a hidden cost that is not in the name. There is a cost involved that is risk for company and for investor. Investors won't give money for free. Now to calculate today's zero coupon bond price, the company quoted at 90 rupees. Face value is 100 and discounted by 10%. Removing this discount, effectively the interest means issuing it for 90 rupees. So the 10% that the company removed is a form of interest. It's a hidden interest that the company removed and issued by saying, give me 90 today and we will give you 100 at maturity. Okay. So the company removed 10%, meaning 90 is the zero coupon bonds price today and that's its price. Now this interest rate that the company is removing, can the company just remove anything it wants? How can you say that zero coupon bond is trading at this price in the market today? A company cannot just deduct the interest or issue as it pleases. The market interest rate is 10%. If the company issues a 100 rupee zero coupon bond for 95, no investor will put money in it. What will the investor say? I can earn 10% in the market and that rate is available anywhere. And if I invest in this company's zero coupon bond, I'll get 100 at maturity for 95. That is, I'll only earn 5%. Am I a fool? No investor puts in money. Similarly, if the market rate is 10% and the company says we are offering 13%, we are issuing at a discount. That means 100 minus 13%, which is 87. The company is not that foolish. The general return in the market is 10% and company returns 13%. Why would company take such loss? There can be exceptions, but this is general scenario. The zero coupon bonds price today is this. You will get this price. Just subtract the current market interest rate from 100. You will get today's price of the zero coupon bond. I placed a bet on the price of the zero coupon bond today. Focusing on interest rate futures, I made a downside bet that its price will fall after 3 months. I made a bet that after 3 months the zero coupon bonds price will fall, and as I previously explained, the underlying asset here is the zero coupon bond, not the interest rate. I said its price will fall. After 3 months, look at its price. After 3 months, the interest rate is 12%. Price 100 minus 12%. If a company issues a zero coupon bond today, its price will be 100 minus 12%, as the market interest rate for today is 12%. The zero coupon bonds market price today is 88. The company bet on the zero coupon bond price at 90 and it is now 88, a gain of 2. A gain of 2. Is this a gain of 2 rupees? This gain is not 2 rupees, but a gain in percentage. Gain is 2%. But how is it expressed? A gain of 2 from 90 to 88 makes sense. How is this gain in percentage? Let me explain. This gain isn't from zero coupon bond price. This gain is ultimately a gain from the change in the interest rate. You should notice one thing. The change in the interest rate today is exactly 2%. If you observe very carefully, you will definitely notice something important right when I placed this bet. The zero coupon bonds price, the market interest rate that day was 10%. What is the market interest rate today? 12%. That means the interest rate has increased by exactly 2%. My gain is precisely from the interest rate change itself. Ultimately, price of the zero coupon bond is derived by subtracting the interest percentage from 100. It's the interest rate change itself given as a percentage. Didn't I tell you that you are ultimately betting on the interest rate? Your gain or loss directly matches the change in the interest rate. You gained. How was the gain decided? We bet the zero coupon bond price would fall. It became 88, and from 90 you see a 2% gain of 2. And you can clearly see it's exactly the same as the change in the interest rate. So couldn't this be a coincidence? That it's exactly the same as the change in interest rate. It's not a coincidence. You can take any number of examples. This will always happen, as it's not a coincidence. It's not a coincidence, and this will always happen. You can try as many examples as you want. Because the zero coupon bonds price is 100 minus the interest rate. This is how interest rate futures work. See what happens here. Remember one thing, the most important thing where you make mistakes. If you notice the interest rate in the market, you would have seen that when the interest rate in the market increased, if the interest rate increased, what happened to the bonds price? When interest rates increase, then the zero coupon bonds price falls. And if interest rate in market falls, the price of zero coupon bond will rise. This means an inverse relationship exists between the interest rate and a zero coupon bonds price. If market interest rates fall, the zero coupon bond price definitely rises. If market interest rates rise, zero coupon bond prices fall. Basic concepts from security valuation I will verify. Look here, right here. You are calculating the price of the zero coupon bond by subtracting the interest rate from 100. If you subtract a higher interest rate, the price of zero coupon bond will be lower. So if the interest rate is higher, the bond's price falls. If market interest rates fall, bond prices rise, as is evident. When interest rates rise, bond prices fall. It's no coincidence. Try any example. For example, falling interest rate, say market interest rate becomes 7%. So the price in the market today would be 93. That is, market price increased from 90 to 93. Interest rates fell from 10 to 7%. Zero coupon bond prices rose. There is an inverse relationship. So from here, I am going to give you a final conclusion. You have understood that if you bet on a zero coupon bond, you are ultimately betting on the interest rate. The gain or loss will accurately match the overall interest rate change, and it's a percentage derived from the interest itself. Always remember it is a percentage and avoid that mistake. It reflects the difference in interest rates, and a detailed discussion is for the regular batch, which we will not do here. To conclude, students often misunderstand the inverse relationship of interest rates and zero coupon bond prices. And so when we talk about entering an interest rate future contract, then what are we betting on? We are betting on the price of zero coupon bond. Now suppose I need to take a loan after 3 months and I am worried that the market interest rate will indeed rise. Should I make an upside bet or a downside bet in the interest rate future contract? This simple question will reveal who has truly understood the core concept. Here you have likely thought of an answer. The correct answer is a downside bet. You will make a downside bet on the interest rate future if you are afraid the interest rate is going to rise. Now some people will say, how a downside bet? You were the one who told us to bet on what we fear. We think the interest rate will rise, so we should bet on that, make an upside bet. Then you have clearly never truly understood the concept, because you have simply just memorized it. You memorized the concept. Look, in this derivative contract, the underlying asset is not the interest rate. The underlying asset here is the zero coupon bond. So here you are betting on the zero coupon bond, so the price of the zero coupon bond. Therefore, you need to tell the stock exchange whether you want to make an upside or downside bet on the zero coupon bonds price. and importantly, not on the interest rate. Look, if I feel the interest rate will rise in the market, this is my fear. Then if the market interest rate rises, understand that the zero coupon bonds price will fall. There is an inverse relationship I verified. I fear interest rates will rise and then the price of zero coupon bonds will fall. The bet is on the zero coupon bond price. Its price will ultimately fall, and consequently, to secure a win, you must place a downside bet. This concludes the explanation for you. You just need to understand this concept and the point is complete. The bet is on zero coupon bond price. Before the next steps, look at one more point. How do we calculate the interest rate futures price? You must take the quoted market price for your buy or sell contract, placing your upside or downside bet. So how to calculate it? 100 minus the interest rate on that date. I just explained how you will be able to get the price of a zero coupon bond for a certain day, but that is the price of zero coupon bond. That's not the interest rate futures price. If you see, its underlying is the zero coupon bond and its price is determined by it. So shouldn't there be some special calculation for it then? No, this simple method is directly followed here. For the IRFs with zero coupon bond underlying, its price is assumed this way in the questions. You can see that the zero coupon bond price is the current IRF price because it is the underlying asset and the future moves with it. 100 minus interest rate on that date. Practically, you get the price. Let's see how this can be used to hedge interest rates. We will do this in 4 steps. First step, decide to buy or sell the interest rate future. So if the company is a borrower, that is, company has to take a loan in future, then it will be afraid that interest rate might go up. The risk of interest rising, it means if interest rate rises, the price of interest rate future will fall. As the zero coupon bond is the underlying, its price will fall. If its price is going to fall, a downside bet, which means to sell IRF. This is the question type you must solve. The other side of the chart is usually not asked. But let's say the company is a lender and wants to make investment after 3 months. The fear in an investment would be the interest rate in the market that's going to fall. If market interest rate falls, then price of interest rate future rises. So you'll make an upside bet on interest rate future, which means you'll buy the IRF. This simple concept is done. That's it. When teaching equity derivatives futures, I noted step 1 was the easiest and somewhat pointless, but you'll definitely make mistake here without truly understanding the logic. The rest steps are normal. Step 2. Now this is a basic point. What we saw in hedging there is similar here, but it's even easier, a smaller portion here. You have already decided whether to buy or sell the interest rate future contract. So now calculate the number of IRF contracts to execute. Just as we saw in equity derivatives, portfolio value into portfolio beta divided by the price of one future contract. We will discuss this similarly here. Now we have to hedge my loan. Now we'll think from the loan's point of view that I have to take money on loan in the future. So I have to hedge my loan. The fear of interest will be on the loan amount itself. Divided by what's the size of future contract, the value of one future contract. So you take that only, then you will get it. How many contracts should be there? Suppose I need a 10 lakh loan. And one future contract of IRF is for 1 lakh rupees. It's for an amount of 1 lakh rupees. I calculated how many contracts are needed and you require 10. This should be the answer. But there's one more significant feature. Just like in equity derivative hedging, we multiplied by the beta of the portfolio. Similarly, we will give an effect here as well. But here we won't use beta, we'll use something else for adjustment. Let's understand the effect. Sometimes what happens, in our example, I need the loan for 6 months. Suppose the loan is needed for 6 months. However, the interest rate future contract in the market has a 3-month maturity. And generally these contracts are for 3 months. I need a loan for 6 months, so I have to pay interest for 6 months. The future contract is for 3 months. So how will my 6-month hedging be possible? What should we do? And after that, multiply it by the ratio of loan duration and future contracts maturity using loan duration in months divided by future contract period in months. For full hedging, determine the number of contracts resulting in 20 contracts by multiplying 10 contracts by loan duration 6 months, contract 3 months. Can you confirm this, as its logic is simple? Look, if I calculate the interest on 10 lakh at 10% for 6 months, I get a certain amount. But now calculating on 10 lakh at 10% for 3 months, the amount is not same. That's why hedging cannot be done as future contract is for 3 months. Did you get it? Now understand this point here. If I had done 10 contracts at a value of 1 lakh, so it would have been 10 lakh worth of contracts, but it wouldn't have been fully hedged for 6 months. Now instead of the 3 by 12 time period, I need a 6 by 12 time period. This means the 3 in numerator needs to be multiplied by 2. So this whole equation needs to be multiplied by 2. You have to multiply by the ratio between the future contract maturity period and the loan duration. If you multiply this by 2, you will get the same amount here and here. So you just multiply by the ratio between the future contract period and the loan duration. I have explained a bit of the logic behind this. Now you should remember, number of contracts is loan amount divided by contract size times loan duration divided by contract period. Step 3. Hedging is done. The maturity day has now arrived, and after hedging, my net interest. If I took a loan, how much did I have to pay? And if I invested, what was the net interest I received? We will see that after hedging. We need to see that at maturity. Now in reality, let's say I took a loan, so I will actually pay interest. I will pay interest on whatever loan I took. It will be paid at actual interest rate. In reality, loan will be at actual interest rate along with gain or loss. Loan amount into actual interest rate into loan duration by 12. The actual market interest rate. If invested, then we consider the receipts. Questions are about the loans and I'll explain them. So if the interest is paid, it is shown as a negative. If received, it is positive, you can show it as desired. If paid is shown as positive, then losses must also be positive and gains will be negative. If paid is shown as negative, a loss will be negative and a gain positive. The logic behind all this is basic mathematics, which I took 10 to 15 minutes on in class. I won't explain that here. You will take the actual interest paid on the loan, and then there will be a gain or a loss on the IRF contract which you have made. So you take that and you will get the net interest paid or received. If you have actual interest paid and there was a loss, both payments adds up. And if there was a gain here, it will be netted off. It's a simple calculation. Now how to calculate the gain or loss on IRF contract is the same as equity derivatives. If you bought IRF and upside betting contract, then at maturity, if its price increases, then it's a gain and loss if it falls. Initially, if you sold a downside bet, then at maturity, if the IRF increases, it's a loss. Here we are talking about the IRF price, means about the price of zero coupon bond. Do not accidentally check the interest rate at maturity for its change, because if you do, your entire solution will be wrong. Okay? Where's the interest rate used? It computes the IRF price, and I have explained the logic. We know if it's a gain or a loss. To calculate its amount, use the number of IRF contracts into future contract size, into the difference between IRF's maturity settlement and initial contracted price. Initial and maturity price difference. Multiply by contract amount. Calculation is the same, but the difference is in percentage. And remember this key point. Whenever you do a question on zero coupon bonds, look here, this difference is in percentage. Remember, it's a percentage. Remember to use percentage, else the question will be wrong. Just remember this. Multiply by the future contract period. Being a percentage, it reflects interest. The ultimate bet was on interest. Time will also be a factor. Take the future contract period and divide it by 12. Fourth and final step. Net interest rate locked by the company due to hedging. After hedging, what is the net interest rate that the company got locked into? We have calculated the net interest amount. Now let's also calculate its rate in percentage terms. So for that, take the net interest amount calculated in step 3. Divided by the loan amount. You'll find out the interest percentage on this loan. This is the actual interest over the period of loan. If the loan is for 6 months, this is for 6 months. To state interest per annum, multiply by 12 and divide by loan months. To express anything as a percentage, you multiply by 100. No formula to memorize here because these are just logical mathematical things. Because there are no formulas in these chapters. Everything is mathematics. I have simply noted this for your revision to avoid any exam problems. This is now complete. Let's move to interest rate futures that have coupon bearing bonds as underlying. In interest rate futures, bonds are underlying. So the bond can be a zero coupon bond or a coupon bearing bond. A bond that has a coupon. It can be a 7% coupon, 8% coupon bond, 6% coupon, 10% coupon, anything. Did you understand? So the coupon bonds can also be underlying in interest rate futures, in which bonds are the underlying asset. It can be any kind of bond. Calculation for coupon bonds. The way of thinking and working is a bit different here. Look, the working proceeds differently in practical life. It's not that detailed in your syllabus regarding hedging and all, just a small part about gain or loss. Let's explain it briefly, not needing as much detail as zero coupon bonds. Now let's approach this exam wise. We will assume settlement by physical delivery. In practical life, you just do a cash settlement. But thinking of physical delivery settlement helps in understanding it better. So we'll assume that. So this will be a contract on the stock exchange to buy or sell a coupon bearing bond on a specified future date at prefixed price, saying that I will sell you this 7% coupon bond at this specific price after 3 months have passed from today, or I will buy this bond from you. Selling means a downside bet and buying means an upside bet. You can think of it as a cash settlement, no problem, the answer will be the same. Let's assume physical delivery for understanding. Let's fully grasp the concept I am explaining here. Now let's see how the working will be, how the interest rate will have an impact on this. How is this a bet on interest rate? I'll quickly explain that to you as well. It's the same thing here. An inverse relationship exists between the interest rate and coupon bond price. If the market interest rate rises, bond prices will fall, and if it falls, bond prices will rise. As taught in security valuation, let's see an example. It's a 7% coupon bond, face value 10,000, a 5-year bond. Today the market interest rate is 10%. Why do market interest rate and coupon percentage differ? If you have this doubt, you have never understood security valuation. Everything is ruined like securities. The very basic thin line of difference was explained there. A coupon is nothing. A coupon is just a formality amount that the company will pay on the face value. The market interest rate means the current market interest rate representing the return people are getting for this type of bond, known as market interest rate. This is about the total return. This is just the coupon on the face value. What coupon is being paid on the face value? So the detailed discussion happens in security valuation. So if we have to find the price of this bond today, what will be its price? We learned in security valuation, it's the present value of future cash flows. A 7% coupon provides 700 cash flow on 10,000 face value. It's at the end of the 5th year. For 10,000, the company redeems its face value. At 10% market interest, PV calculation shows bond price should be 8,864. Wasn't this called fair value or intrinsic value? Yes, we did, but this is the fair price at which the bond should be. The actual price will be somewhere around this. It could be 8,800 or maybe 8,900. It doesn't deviate much from this in practical life. If the price deviates too much, people will make huge profits. In reality, all factors included, the price is approximately this. To grasp our concept, let's look at it, and this is the bond's current price today. Now I feel that the market interest rate is going to rise. I have this fear because I need to take a loan in the future. I need a loan in 3 months, fearing rising interest rates. If interest rates rise, bond prices fall. So its price will ultimately fall. And the contract is on this bond, which is the underlying asset. What should ultimately be done here? A downside bet was made, and the logic is the same as for the zero coupon bond. After 3 months, the market interest rate became 12%, it increased. Now calculate this bond's price. If we look at the cash flow of 700 for 5 years for this bond, and redemption of 10,000 at face value at 5th year end. At a 12% rate, if we calculate the PV now, its price today should be 8,194. This PV calculation is from security valuation. It's not relevant here, I explained it for logic. Struggle without security valuation. Price is 8,194. And for bond that would sell for 8,864, at time 0 I made a downside bet that would be sold for 8,864 after 3 months, a downside bet. Later that bond's price in market became 8,194, so I'll buy it for 8,194 and would sell it for 8,864, making a profit of 670. Consider it a downside bet. I said 8,864, price fell, and that's my profit. But we will proceed by assuming physical delivery to truly understand this better. Why did the price change? It is because the market interest rate changed. The change will be exactly as much as the change in interest rate. So here too, you are betting on the interest rate through the coupon bearing bond. Therefore, this is also an interest rate future contract. Now at maturity, as I told you, the settlement will happen. I just showed it too. Now let's read a few more things about this. This contract is for a notional bond. And what does notional mean? I said it's a 7% coupon bond. I will give you the bond after 3 months at a price of 8,864. As per my example, I'm saying I will sell it to you at this price. This is what I said. Now a 7% coupon bond can be any bond. In practical life, the contract is for a notional bond. Notional bond means any bond. I didn't specify that I will give this particular bond a 7% coupon one. So when maturity day comes on that day, I can pick up any bond from all the bonds that are currently listed on the NSE, and it's crucial to understand that it's not necessary that an exact 7% coupon bond will be available on the NSE at maturity. It's possible that a 7% coupon bond might not even be available, a 6% listed on NSE. So I can pick up a 6% coupon bond and give it to the buyer who has a contract to buy. It means I can pick up and give any bond. It can be an 8% or a 5% coupon, any bond, on maturity day. From all the deliverable bonds which are listed on the NSE, I can pick up any bond and then simply give it if I have a contract to sell. So does that mean as a seller, I would want to pick up the bond that gives me the most benefit? Yes, absolutely. That's what I do. The seller of an IRF contract can deliver any bond on maturity. He will always choose the cheapest to deliver bond, cheapest to deliver, okay? Which bond will I choose? At maturity, I will buy the cheapest bond available in the market and deliver it at the contracted price of 8,864. Understood? And the buyer will have to accept it. So can you tell me, does this mean that whoever has a contract to buy in this contract will be in a disadvantageous position. It's not like that. It's not like that. To avoid this, the stock exchange makes a change in the calculation. Let's understand what that change is. The rest remained normal and unchanged. This was the sole explanation. The stock exchange, for example, specifies the future settlement price for a contract selling at 8,864. Today, if I pick up any bond from the market, I will pick it from the market, so it's quoted price. I will pay for the bond, and upon its purchase, money will go out. I will sell the bond at the contracted price, that is the future settlement price. This will be my gain loss. So if we talk about the example above, I said I would sell at 8,864. Okay, this is done. Minus 8,194, and assume it's the same 7% coupon bond. Minus 8,194, gain was 670. Now what does the stock exchange do in this? Since it's the same 7% bond, there's no problem. In this case, the stock exchange talks about multiplying the future settlement price by a conversion factor. In this case, the conversion factor became 1 because I delivered the same bond I mentioned, the 7% coupon one. Now suppose, for instance, I then transfer a 6% coupon bond to the buyer. I quoted it at 8,864. A 6% coupon bond. This particular bond has a 6% coupon. So buyer will get less cash flow from this bond in future. The value of this bond will be lower. Assume this bond's value is 8,000. Remember, the previous was 8,194, and this is a rough figure, no calculations. The buyer incurs a loss, and the stock exchange directs you to multiply your future settlement price by a conversion factor. The conversion factor published by the stock exchange will be given in the question. You do not have to worry about its origin because it is the stock exchange's working, not your business. The stock exchange said that you will sell a 7% coupon bond for 8,864. So this is what you said. Now you are giving a 6% coupon bond, which is a cheaper bond. So look, the selling price should also be lower. You shouldn't get the full 8,864. It says you should get 0.9050 of it. It's 0.9050, so it is clearly said that you should only get 90.5% of this price. It's fair because you are giving a cheaper bond, okay? Suppose I transfer an 8% coupon bond priced at 8,300. I am giving a bond of higher value, but the buyer does not get a bigger advantage. In this case, the stock exchange will get me more money. It will say it would give me a 7% coupon bond for 8,864. If I'm giving 8% coupon bond, I should get more money. So as per stock exchange, conversion factor is 1.050. And you should get this much times the money for today. So the stock exchange does this work. It's a pointless point, just keep it in mind. Now in this case, how will the seller's profit be calculated? The seller will analyze all the bonds in the market to see which bond to deliver to get the maximum profit. So for every deliverable bond that is there, the seller will calculate their profit or loss. Profits won't be equal for all, each will have a slight difference. Okay? The seller calculates profit on each bond, future contract settlement price into conversion factor minus maturity price. Conversion factor from stock exchange is given in question. In step 2, whichever bond they see is the most profit in delivering, what they will do is select that bond. This is a pointless topic. Interest rate futures concluded. Moving to chapter's 4th part. Interest rate options, which you can call as the IRO. Interest rate options, take a look. This part is very easy. You won't have much trouble with this. It's a very simple part if we understand it conceptually. Look at interest rate options now. You understand options, right? An option contract, a derivative contract, options mean choice. I have a choice. I can do this if I want. Remember, the whole feeling of equity derivatives, you have to keep that in your mind for these options. The exact same feeling and logic will work here, and all calculations will now be based on interest rates. The same logics are going to work here. You should have all those things in your mind beforehand, otherwise everything will go over your head. Options imply having a choice, and we will be discussing that concept. Now see, the first type of interest rate options is the interest rate guarantee, just like call and put options in equity derivatives. Similarly, the first is the interest rate guarantee. You just observe this. Not very useful, but review it because if a question comes under the name of interest rate guarantee, solving interest rate option questions, what happens in interest rate guarantee options? A guarantee of the interest rate is given. It's a kind of physical settlement scenario. In this, look, the option contracts are over the counter. All over the counter contracts for interest rate derivatives are with banks. So this is also a contract that is made with the bank. And for what it is to buy the right. Okay? To take a loan at a strike rate for a loan of a certain maturity after a specified period. I personally went to the banker and explained to him that 6 months from today, if I truly want to, I can definitely take a 3-month loan from you at a 10% fixed rate. This differs subtly from FRA but is essentially the same as an FRA. What did I say in FRA? I will take a 3-month loan from you at a 10% rate 6 months from today. So after 6 months, I will have to take it at a 10% rate. In an FRA, I was actually taking it, so both gain and loss situations were possible. Both gain and loss situations were possible even though the cash settlement aspect was secondary. There could be a gain or a loss. But here, I am taking an option, I am the option buyer. I am buying an option from the bank, so I am the option buyer. I have a choice, that's a right. If I want, I can take a 3-month loan from the bank at 10% rate after 6 months. This will be called the strike rate. Here 10% is the strike rate of interest. Understood? The rest logic is same. Just like in equity derivatives, I'll buy a Reliance share from you for 2,500 after 3 months. It is the very same thing here, because if I want, I will take a 10 lakh rupees loan for 3 months from you at a 10% rate after 6 months. So I will take it if I want to. I have a choice here, and I will feel that if the interest rate in the market rises after 6 months, I will take the loan at 10%. There will be an actual settlement. And if the market interest rate doesn't increase, if market rates fall, why take the loan at the contracted 10%? I have a choice and will take it from the market cheaper. I will have this feature in the interest rate guarantee concluding the explanation. Once you understand the logic and grasp the feeling of derivatives, subsequent parts will follow automatically. So I will also have to pay an interest rate guarantee premium because I have taken this choice, so I won't get it for free. Because it's simple, if it's beneficial for me, I will exercise this guarantee option. Otherwise, I won't. So either I will have a benefit or nothing will happen. I can't have a loss in this case. But the option seller, who is the banker, if I exercise the option, he faces a loss, otherwise nothing happens. That person never profits. Therefore, we provide him a premium at time 0, an interest rate guarantee premium to compensate him. This will then become his profit when not exercised. So his profit is limited and my profit is unlimited. His loss is unlimited. My loss is limited to the premium paid. This is just like the equity derivatives do not ask for reasons. Then revised derivatives. I will pay the interest rate guarantee premium to the bank at time 0. I am buying the right at the beginning, the right to take a loan at the strike rate. So I am buying the right at time 0 itself and paying the premium. Remember this. After the specified period, I can take a 3 months loan at 10% 6 months later. After the 6-month period, after 6 months, I'll check the actual interest rate in market. Has it become higher than the strike rate? If yes, then I'll exercise the option and take the loan at the strike rate. Suppose I had said 10% and the market rate is 12%, then I'll take the loan at 10%. So I have an option. But if the market interest becomes 8% and strike rate 10%, the actual interest rate is lower and market strike rate is higher. Why exercise the option? It is foolish to take a 10% loan when 8% is available in market. I will take that. That's it. Now in the practical life exam question, you will typically be asked to either state or calculate. So in this case, what is your total interest amount payable on loan? So total interest amount payable means one is the loan you'll actually take. The interest amount will be calculated as per the selected rate. You will see the market rate and then decide whether to take the loan at the market rate or the strike rate. Clear? Loan amount into interest rate into time, and you have understood this, no formula needed. Plus the interest rate guarantee premium amount. To pay this interest, I also paid the interest rate guarantee premium at time 0. That's also my total payment. By entering this option contract, I had to pay this interest at selected rate. I paid it having paid the interest rate guarantee premium. You also have to add that to show the total interest. The payable amount is this much. You have a question on this and you must do it this way, which I had explained, and you have to calculate it in the same way. Now look further. So in interest rate options, I've already completed first type, the interest rate guarantee. Now we have other types such as the cap option and floor option. There are many types of interest rate options and people often mix them up and get confused with these concepts. Interest rate options seem strange and its name might shock you. If you have studied this before, you were likely shocked thinking how confusing it seemed. But as you will see now, the cap and floor option is actually a very simple topic. There's nothing to it. See, when we talk about interest rate options, if we discuss interest rate options. So interest rate options come in many varieties. The first one was interest rate guarantee. You have learned and understood. The second one is cap option. And one is floor option. Just like equity derivatives had call and put options, here interest rate options have many types. We have already cleared up the interest rate guarantee, which was simple. Now the cap and floor option. A cap option is very similar to equity derivatives call option. That's what a cap option is in interest rate derivatives. It's a call option. A put option in equity derivatives is now called a floor option in interest rate derivatives. We have two types of interest rate derivative options to understand. What are they? It is very simple, and first we'll discuss the cap option. Look, cap option and floor option. Both of these are used for floating interest rate loan. For what? For floating interest rate loan. These are used for floating interest rate loan, and crucially remember, they are never for fixed interest rate loan. For fixed interest rates, we already looked at interest rate guarantee needing a loan after a certain time and to make a contract at a fixed rate. So this is also there. If you want to create a derivative contract for a floating interest rate loan, then the cap and floor options come into play. Now let's see how they work. It is used for floating interest rate loan first. We discuss the cap option, putting floor option aside. Let's discuss the cap option with an example. Suppose I need a loan for 2 years. I need a 2-year loan. Now I have a 2-year floating rate loan with 6-month resets. This means that every 6 months interest rate adjusts according to market rate. My rate will keep resetting. So in this, within 2 years, I'll have these 6-month periods, 6 months, 12 months, 18 months, and at the end of the 24th month, in this way, 4 reset periods will be formed. Now see what's happening. You know what will happen here. If the 6-month LIBOR is 10% today, the first 6-month interest installment will be paid here at 10%. Then if rate becomes 9%, here the interest from here to here will be paid at 9%, 9.5% will be paid at 9.5%, and 11% at 11% from here to here. Whatever interest rate is in market, payment for next 6 months is accordingly. Interest payments will continue because of the 6-month reset period, and this is a floating interest rate loan as explained earlier. In this chapter, floating interest rate loan calculations start here. So these are our benchmark rates. We call them benchmark rates, which we use as LIBOR for our example. Now look, today at time 0, I have a loan with a 10% interest rate, and I know that the interest for the next 6 months will also be 10%, and that is not an issue at all. But for the remaining period, 6 months, 12 months, or 18 months, or 24 months from today, I don't know what the market rate will be. And whatever market rate is on those days, I'll have to pay interest for next 6 months accordingly, because it's a floating interest rate loan. So now I am getting worried. What am I worried about? What if the market interest rate rises? If it truly increases, then I will certainly suffer a loss. This is because I will have to pay interest at a much higher rate for the upcoming 6-month period. Because I don't know today what the interest rate will be after 6 months, 12 months, or 18 months. I don't have a time machine. So I'm getting worried. So to protect myself from this risk, I can use a cap option. What is that? It's used by someone who is afraid of the interest rate rising, someone who is afraid of the interest rate increasing. So in this cap option, a strike rate is fixed. For example, the strike rate is 10%. Options have a strike rate. What exactly does a strike rate of 10% mean to US? If I buy a cap option, I will get the right at 10%. You may have already understood a little what this means, but if not, I will certainly explain it. Cap means an upper limit. You wear a cap on your head, right? A normal cap is worn on the head. Think of it that way. A cap is at the very top. It's on your head. That means a cap is an upper limit. Nothing can go above it. Nothing above this. So I have bought a cap option with a strike rate of 10%. This means if the interest rate goes above this, I will get a payoff for it. What do you get in an option? A payoff. Remember equity derivatives if you are confused by the word payoff. Remember equity derivatives to truly understand cap options. It is like a call option, so if the market price went above the strike, the difference was the option buyer's payoff and the option seller would pay that amount. The exact same principle applies. Having taken a cap option at 10% strike, let's see what happens. Initially the rate is 10% and the interest for 6 months will be paid here. The interest rate that exists in the market at time 0 is generally the same as or even higher than the strike rate of the cap option. This means in the first reset period, you will never get a payoff from it. The payoff will come later. After 6 months, the market rate becomes 11%. If it becomes 11%, then the actual interest payment will happen here at the end of the 12th month at 11%. Well, I have taken the loan at a floating rate, so if it becomes 11%, I'll have to pay 6 months of interest here accordingly. But I have taken a cap option with a strike rate of 10%. Since the interest rate has gone 1% above 10%, becoming 11%, I will get a payoff of 1%. 1% of the loan amount for this period. From 6 months to 12 months, I'll get a payoff here, so my net interest will be lower. Similarly, at the end of the 12th month, the rate becomes 10.5% and the interest for this period will be at 10.5%. Cap's strike rate 10%, meaning I will get 0.50% payoff here. Then money will come into the bank. At the 18th month, the rate becomes 9.5%, and by the 24th month, I must pay interest at 9.5%. Now tell me, what's the cap payoff if the strike rate is higher and the market interest rate is lower? There will be no payoff. The payoff comes when the market interest rate is higher. Will I have to pay here? Do not say that I will have to pay 0.5%. This is an option. It is about choice. So those who buy an option either get a payoff or their payoff is zero. It is never negative. I have already explained the reason for this in equity derivatives and also a little while ago. So I don't have to pay anything. My payoff will be zero in this case. Understood? It's very basic and nothing more. As I said, the first payment is at 10%. So that payment is made here. Once it becomes 11% after 6 months, it will be above the strike rate. An extra 1% payoff will then come. I will pay the full 11% interest and then immediately get the payoff. This payoff is received on the exact interest payment day. The interest payment is happening here, and the option payoff is also received on this very day, adjusted within this. Alright, so this is what's written, what I've noted down here. You can read it on each reset date. If the benchmark rate of the floating interest rate loan exceeds the strike rate of the cap option, this means on every reset date, you will diligently check if the market interest rate is going above the option's strike rate, and if it goes above that, then the option buyer will get a proper payoff from the option seller on the next interest payment date. This interest payment is going to happen on the next date. You can call it the next reset date, which for us is the interest payment date. Interest for today's reset is paid on the next reset date. We call that the interest payment date according to this reset date. Understood? Keep this in mind. So the payoff settlement will happen on that day itself. It will happen on that same day. It's just a call option. The market rate went above the strike rate. You will get a payoff. How much will the payoff be? It's very easy. It's the loan amount multiplied by the difference between the benchmark rate on reset date, the strike rate, that is 1%. Multiply by its duration, matching the interest period, days or months from reset to payment date, divided by 365 or 12. You will take the payoff for these specific 6 months. As you are going to pay 6 months of interest, you will certainly claim that 1% difference for this period. That's all there is to it, nothing more. Now I have written here for clarification, if the benchmark rate on the reset date does not exceed the strike rate and remains lower in the market, then in this scenario the payoff will be zero. It can never be negative in any case. Just remember that. That's it. That's the cap or call option. Now floor put option. Cap option understood. Then floor option is simple. Floor options are utilized by people who are greedy, while cap options suit the risk averse. Suppose I have taken a loan and this is a floating interest rate loan. I feel the market interest rate will fall, and that's good because if it drops, I will pay at a lower rate. My payment will be made. So no need for a cap option then. But I am a greedy person. What am I? What am I doing? I am a greedy person. I take a floor option. What does a floor option mean? Suppose its strike rate is 4%. This means if the market rate goes below 4%, right? If it goes below 4%, then I will get a payoff. What's a floor option like? It's like a put option. In a put option, if market price falls below the strike, then you get a payoff, and if the market price falls below strike, you receive the difference. So understand the floor option by its name. Where is the floor? It's your ground below you. Nothing is below it. If the price or the interest rate in market falls below this, then I'll get that difference as a payoff. Means suppose in market, like after 6 months today, it's 10%. So the payment will be made here. After 6 months, the market rate becomes 3%. So interest will be paid at 3%. And I have bought a floor option. I bought a floor option. The market rate became 3%. It went below 4, below the strike rate. So I will also get a payoff of 1%. So my net interest will be this much. I am a greedy person. That's why I took the floor option. Understood? I am not hedging. Instead, I am simply greedy. Similarly, it became 2.5% and the payment will be made at 2.5%. But because the interest rate is below 4, I will also get a payoff of 1.5%. Payment is made and payoff received. My interest becomes cheaper. But do you know what if? When the market interest rate exceeds the strike, the normal payment will be made. But don't tell me that I will have to pay the payoff, because I am an option buyer. I will get a payoff or it will be zero. Suppose the market rate becomes 6%. Then pay interest and there's no payout from the floor. Remember this simple point. If I have bought a cap option, then market rate is higher than strike gives payoff or it's zero. That's all. If you have a floor option and market rate falls below strike, you get a payoff. Otherwise, it's zero. You should always remember one very crucial point, because it can never practically happen that suppose I bought a cap option and a floor option. You generally will not find this in the market, and if it does happen, you will always get payoff from only one. Market rates will either rise or fall, because both things cannot happen at the same time. These basic things I have told. So that's all there is. In a floor option on every reset date, if the benchmark rate of the floating interest rate loan goes below the strike rate, the option buyer receives a payoff on the next interest payment date. Calculation: loan amount into strike rate minus benchmark rate. Multiply by duration, divide by 365 or 12. If the benchmark rate on the reset date does not go below the strike rate, the payoff will be zero but not negative in any scenario. Now for any cap or floor option you take, a premium is typically paid at time zero, and this is given by the buyer to the seller. The option premium is simply the loan amount multiplied by its premium percentage, and I have written this basic point down for you. Now before I proceed, I want to clarify one point. Most students make a mistake in one particular question. In that question, suppose the loan we have taken is at LIBOR plus 2%. So what rate has been mentioned? A fixed component is mentioned along with the floating rate. Now students, let's suppose we had a cap option. Cap option of 10%. The cap option was for 10%. And so in the market, the LIBOR became 9%. So the LIBOR in the market became 9%. Listen carefully, I'm clarifying a point. These points will prevent problems. See, my cap option is at 10%. It's a 10% cap option, right? What was the market LIBOR? 9%. Loan taken was LIBOR plus 2%. Actual interest paid will be 11%. 9 plus 2 equals 11. The cap option was for 10% and a 1% payoff should be received. If anyone does this, expect 0 marks. You have made a mistake. You have misunderstood the concept. The 2% was a fixed interest component. Cap or floor options are for floating interest and for floating rates. Cap and floor options are not for fixed interest part that has to be paid anyway. Compare it with the floating rate. What's the floating rate? 9% LIBOR. Compare with that, it's 9%. The cap option is 10%. There is no payoff. The payoff is 0 in this case. There is a question where you make this mistake. I have written here clearly, for those who don't understand, I have written it clearly. If the benchmark rate exceeds the strike rate, you must compare it with the benchmark rate. The benchmark rate means LIBOR, MIBOR, BPLR. You should not compare with the plus percentage component. I've clearly explained, yet mistakes occur. For cap and floor options, students, please note that your reference rate for making these important comparisons is exclusively the benchmark rate, such as LIBOR, MIBOR or BPLR. The fixed component with plus sign is not used. It is for actual interest calculation. But do not consider it when checking for the payoff. I have also told you this when I was solving it in class. If I want to show you the solution I did in class once of that question. This is the solution to the question we did in class. Here your strike rate was explicitly set at 8.5%. Yes, exactly 8.5%. And particularly the loan that we had taken. This is the question. The cap options strike rate was set at 8%. Just note that you have a question. The strike rate is 8%. And the loan we had taken was at LIBOR plus 0.5%, a floating interest. But what do we compare the cap and floor options with? Only with LIBOR, the benchmark rates. I told you this. So when we were looking at the working for the cap option. So look here. Students, your strike rate for the cap option is actually set at 8%. Initially it's 7% plus 0.5, so payment was 7.5%. No payoff generated as it's below 8%. Now when the market rate became 8%, look, the market LIBOR was also 8% as I have written. What will the actual interest be? 8 plus 0.5%. Now tell me, will there be a payoff in this case? Now if you compare it with the actual interest rate, you might assume a payoff exists for the 8% strike, but the payoff is actually 0. Because comparison is solely with LIBOR benchmark, payoff is 0. This point I wanted to make, which is from the class solution I did. All the details are explained there. Alright, next. Now there's another note. I've explained one note. Now look at the second one. It's a very simple note related to question I just explained, interest rate, collar and all the things. Within options, we have interest rate guarantee, cap option, floor option. There's a bit more, but this is the last bit and you'll understand it. Explained interest rate guarantee, cap and collar options. Now interest rate collar. Some might mistakenly consider this a separate option, but it's not an option. It is truly a strategy. In this, what we do is buy a cap option on the loan and sell a floor option. So what does this mean? Listen carefully. It's very simple. What is interest rate collar strategy? I took a 2-year loan at a floating rate. And I'm worried that the interest rate in the market might rise. I'm worried, so I have bought a cap option. Should I buy a cap option? I need to hedge. I will buy a cap option. Okay, I will buy a cap option. Up to here, it's normal. But now I have realized to buy a cap option, I have to pay premium at time 0, and this premium must be paid to the option seller. So this will be a cost for me. Now I don't want to incur this cost but want this option for free. So I thought over this. I believe the interest rate will likely rise. According to me and my analysis. Based on my analysis, interest rates won't fall. But someone in the market might still think they will. As I've mentioned, all kinds of people exist. Don't assume that everyone thinks exactly like you, and if such a question arises in your mind, just ignore it. Someone in the market might also think rates will fall. If someone thinks the interest rate will fall, they would buy a floor option, which then benefits them only when the market rate falls. They would buy a floor option. So I thought, why not sell a floor option to someone? I will sell a floor option to collect its premium, then use that to buy a cap option, completing my hedging. In a floor option, if I buy it, I get a payoff. If I sell a floor option, I will have to pay the payoff, right? If I sell the floor option, then a payoff will not come, it will go. But I think the interest rate will rise. If it rises, I'll get a payoff from the cap option, but I won't have to pay a payoff for the floor option. When would I need to pay a payoff on a floor option? When the interest rate in the market falls. Only then does the option buyer must give floor option payoff. So I think the interest rate will rise. I'll sell floor option, collect premium and use it to buy a cap option. Hedging is done and nothing paid for premium. Over smart people often use the interest rate collar strategy. This involves them buying a cap option and selling a floor option to make their net premium zero. Collected premium from one paid for the other. Understood? In this case, there could be heavy loss. They thought the interest rate would rise, but what if it didn't? So no payoff from cap option and rate fell. They will pay the floor option payoff, and this is what happens in the question. I had you work on this. This explains interest rate collar. You buy a cap option and sell a floor option on a loan. In a cap option, you receive a payoff, and in a floor option, you pay a payoff. This occurs on the interest payment dates. Next, we have the third and final note in this topic. If the question asks you to identify how much interest rate risk you have hedged, by using this option, you can use a cap option to hedge this interest rate risk. So tell me, how much interest rate risk have you hedged by using the option? Meaning, how much benefit did you get from using the option? How much profit did you make from option contract? That is, how much was the payoff? In other words, the gain or loss is asked. It's simple. So the gain or loss from an option is called the net payoff. We need to state the net amount, how much we profited by entering the option contract. What does hedging the risk mean? The extra amount we had to pay due to the market interest rate, we got that back. That is the payoff. This payoff was received from entering the option contract, but to get it, I also had to pay an option premium. This wasn't free, it came from your pocket. The net gain or loss is net payoff. Remember equity derivatives. So to find gain or loss, that is the net payoff, we need to calculate it. So if question asks to tell how much interest rate risk is hedged by these options, it is asking for the net payoff. Now how will you calculate the net payoff? Payoffs received differently. Now a cap option has multiple interest payment dates and payoffs can occur on those different dates. So the net payoff will be calculated for each date. You will calculate the net payoff on each interest payment date and then total it. Calculate the net payoff on each interest payment date and then total it. How is the net payoff actually determined and what amount was received on each date? Minus how much premium was paid. So the premium is paid once at time 0. You know, it's not paid on every payment date, right? The premium paid at time 0 requires allocation to payment dates. You must clearly understand the example. See, you have to tell that how much interest rate risk you have hedged. You have to state net payoff, gain or loss received from option minus option premium. The net payoff is gone, but the payoff comes on every reset and on every payment date. Suppose, for example, it is a 2-year loan. Look, you have the first, second, third and fourth payment dates. The initial rate payment will occur here, then the 6-month rate will be paid here and other payments will happen at these points. For now, we are assuming that you will receive a payoff on every date. If you do not get one, then your payoff will simply be 0. So I can calculate payoff on every date on all 4 interest payment dates in our example. This is the payoff, but I need the net payoff, so I have to subtract the option premium, but I paid it at time 0, suppose 1 lakh. How do I calculate the net gain or loss on each payment? The net payoff, right? You must allocate this option premium to each payment date. How will you allocate it? There are 4 payment dates. Let's divide by 4. That makes it 25,000. We will allocate an option premium of 25,000 to each payment date and then we will get the net payoff and subtract this. Understood? So don't do it like that. You cannot allocate the option premium directly. What you thought is correct, that we will allocate it. But you cannot allocate it directly like that. Why not? Because I paid the option premium at time 0 and the interest payment dates are in the future. So you also have to consider the time value of money. So now think about it this way. If I had paid the option premium on all 4 payment dates to the option seller, then what would the amount of that option premium be? and amount X on all 4 dates would be equal, but how much should that amount be on all 4 dates? So that if we calculate its present value, it equals 1 lakh today, because at time 0 I paid an option premium of 1 lakh. So if I were to give the option premium on all 4 payment dates, I'm just thinking this way. If I were to give the option premium in installments on all 4 dates, then what would that amount be? So how much should that amount be? So 25,000, 25,000. If it were that much, its PV wouldn't be 1 lakh, right? I gave 1 lakh. So the option premium amount on all 4 dates should be such that its PV equals 1 lakh. So I have considered it as X, the option premium, to be allocated to all 4 payment dates. So that X amount, if we calculate its PV, will be same amount for all 4. So you'll take the PV annuity factor, what we call PVAF. Multiply it and it should be equal to 1 lakh. So how do you find X? 1 lakh. This is in multiplication, so it goes to division on the other side. So 1 lakh divided by PVF. This is the formula we get. You'll have to find the option premium allocated to each payment date. That will be option premium paid at the beginning, divided by PVAF. For PVAF, what you would need is a discounting factor and also the time. So in our example, there were 4 periods of 6 months each. We have 4 6-month periods. What discounting rate should we take? Discounting rate, the interest. You will take fixed interest rate. Remember, you'll do the PV with the fixed interest rate. The fixed interest rate for all payment dates. There were 4 periods in our example. So whatever fixed rate is given, you'll use its PVF. Both floating interest rate and fixed. Can we take by floating rate? No. Now let us understand why. Always use the fixed rate. The reason for your decision to enter this option contract is primarily because you were worried about floating interest rate in market rising, and that's why you chose to enter this agreement and paid option premium. Now at time 0, I am thinking that I will borrow money for the option premium and then pay. We do the PV thinking according to that. Okay, so I will pay that. So when I borrow money for the option premium, then if I borrow at a floating interest rate as well, then there will again be a risk of the interest rate rising. How will I hedge this? Will I take another option for this? This cycle will never be complete. Therefore, we assume that the money we borrow for the option premium will be at a fixed interest rate. This is the logic behind it. We had this detail in the lecture, so we won't discuss it much further. It's not in the exam. The net payoff or gain loss on each interest payment date is that date's payoff, the option's allocated premium. So I taught you to calculate payoff and get option premium. The option premium paid at beginning divided by PVF at a fixed interest rate. Let's look at an example. I took a 1 crore loan, 6-month LIBOR for 2 years, means its recite period is 6 months. So I have bought a cap option with an 8% strike rate. Cap option premium 1%, fixed interest rate 7% annually. Calculate premium for each payment date. How much option premium was paid? 1% of loan, 1 lakh. In 2 years, 4 6-month interest payment dates need premium allocation. The fixed interest rate is 7%. Now see, your 4 periods are of 6 months each. So don't directly calculate the PV factor for 4 periods at 7%. Remember, from security valuation, a 7% annual rate for a 6-month period is half to 3.5%. Total the 4 PV factors at 3.5%, the PVF is 3.673. Always remember this important point we have studied in our regular security valuation lectures. So option premium at each payment date is 1 lakh at beginning divided by the PVAF. We have successfully calculated it. Interest rate options are complete. Now, for the chapter's final part, the 5th, interest rate swaps, IRS. It's a very simple and small part. These are interest rate derivatives, derivative contracts with an underlying interest rate in which the nature of the contract is a swap-like contract. Now I have previously taught you about equity swaps and derivatives, and the very same logic and working will apply here. I will give an example from there and you will understand this from it. What did I explain there? Suppose I invested 100 crore in a portfolio of shares. I am thinking after 3 months, the return I will get on this share portfolio is not fixed. The market can have any return. You can call a floating variable return. I do not know, and now I'm worried. So I approached my friend. My friend said, do not worry. After 3 months, I'll give you this much fixed return on 100 crore. What your portfolio earns, just transfer to me. This is called swapping. What you have, give it to me, and you can take what I have. It's an instrument for wish fulfillment. I'm actually making my wishes come true. It's like when you see something someone else has and wish you could have it yourself. So it's possible through a swap. You can contact them if you want. The other person and everyone else also agrees. That's a different matter. But entering a swap contract might make you happy, but it's not always necessary. It's a derivative contract. There can be a profit or a loss. I told the other person to transfer my portfolio's return and you give me a fixed return of 10% after 3 months. After 3 months, the portfolio's return may vary. If higher, then more will go from me and less will come in. It's a loss. If after 3 months portfolio returns less, then less goes from me and more comes in, it's a profit. Understand, anything can happen. It's like seeing someone else's girlfriend and think she's better. Let's make a swapping contract. You made a swap contract, then the reality came closer, that my girlfriend was better. So only when transaction is executed, you'll know if it's profit or loss. From a distance, everything looks attractive. This is known as swapping. So you can swap anything, meaning you need to exchange. You can exchange anything. There we were talking about exchanging the return of an equity portfolio. Here it's an interest rate swap. So we will talk about exchanging interest rates. We will talk about exchanging interest rates. What are interest rates on? On loan, so the loan will also be involved. Let's say I have taken a loan and this loan carries a floating interest rate. And I'm worried that market interest rate will rise. What am I worried about? That the market interest rate will rise. So I'm just crying that market interest rate will rise. Suppose I took a loan of 10 lakh at floating rate. Reset period is 6 months. Suppose the next reset date is on the 1st of January. Then on that day, whatever the interest. On 30th June, 6 months later, I must make the interest payment. And I'm worried that the market interest rate will significantly rise on that day. I told my friend Mr. B, asking what to do. Mr. B said, friend, do not worry, I am your friend. So don't take tension. Whatever your floating interest rate is in the market, I will pay that interest. Whatever the interest rate becomes on January 1st, I will certainly cover your floating interest payment for the next 6 months. I will pay you, you go and give it to the lender. Mr. A said, you're a friend for paying interest. Then Mr. B replied, but listen, it's not for free. In return, you're worried the fixed interest rate will rise, right? Look, you are thinking that I wish I had taken a loan at a fixed rate as the floating rate will rise. Mr. A is thinking I wish I had taken a loan at a fixed rate. So he will fulfill his wish. So Mr. A says, I will give you fixed interest at 8% per annum. Rates are per annum if nothing is mentioned. I will give you a fixed interest rate for 6 months at 8%, and then whatever the market rate is, you give me that. We are simply exchanging the loan's interest rates, and that is swapping. So I will pay Mr. B a fixed interest rate of 8% for 6 months. The market rate is unknown. Mr. B will give me interest for 6 months according to the market rate, and I will give that same interest to my lender. My loan has automatically converted into a fixed interest loan and my wish has been fulfilled. This is a swapping contract. It's very simple. So what will Mr. A pay? 8% of 10 lakh for 6 months, that's 6 by 12. Now let's just look at it normally. I'll remove this for a moment. Then I will explain it later. Of 6 months. I will pay this fixed interest amount to Mr. B. Now what will I get from Mr. B? I will get the floating interest from Mr. B. Let's assume on the 1st of January the market interest rate will be 10%. So I will get 10% interest from Mr. B for 6 months. It means I will certainly be getting a larger amount. And I gave less, so I made a profit. Mr. B is crying thinking, what kind of help did I just give? Mr. B shall take the floating payment and convert to a fixed rate loan. Now what happens if the market rate becomes 5%? Even then I am Mr. A, I made a contract, I made a promise, so I have to keep it. I will have to pay Mr. B 8% fixed interest. Now Mr. B will only pay me 5%, I will only receive 5%, which I will then give to the lender. Now I can tell my friend that I'm happy with my floating rate loan. You can keep your side of the deal. No. Once you've made a swapping contract, you have to exchange. You can't back out now. Now I have to give him 8% and take the interest based on the floating market rate. Okay. I will give the rest to the lender. It's a very simple and basic fundamental concept. Okay. Now interest rate swaps. Interest rate swap is the exchange of interest payments between two parties on a notional principal amount. Two parties agree to exchange interest payments, fixed rate and floating rate. One will pay a fixed rate, the other will pay a floating rate. The notional principal amount isn't necessary. It doesn't have to be same as loan amount. In contract, I can do it for 5 lakh, 7 lakh or any amount. The party paying a fixed interest amount is commonly called the fixed rate payer. And in our example, Mr. A was giving a fixed amount. Mr. A becomes the fixed payer. Here Mr. B was talking about paying the floating interest Mr. B. So Mr. B in our example is the floating rate payer. Mr. B is giving the floating interest and he is the floating rate payer. One party makes fixed payments, we call them the fixed rate payer. The other party pays interest according to the floating rate, known as the floating rate payer. These are interest rate swap basics. See, for the exam, this topic is even easier than it is to understand. So for the exam now, in this, interest rate swaps have types, and this is a very easy topic that offers free exam marks. Just follow what is written in the notes. There are different types of interest rate swaps we need to look in the market. The first is the plain vanilla swap. Hearing vanilla reminds you of ice cream, right? You will think of ice cream after hearing this plain vanilla swap. It is also called a generic swap or coupon swap, and my friend, I will explain its plain vanilla name like ice cream. See, the plain vanilla swap is a general purpose swap that is commonly done in the market. If you generally do an interest rate swap in the market, it will be this contract which is called a plain vanilla swap, a generic swap. It's also simply called a coupon swap and is generally done in the market. So this swap is done in the market. The nature of the interest rate swap is like this. Because the person who created plain vanilla swap for the first time, that person must have been a fan of ice cream. He must have liked ice cream. So just as vanilla ice cream is common plain vanilla, when you name an ice cream plain vanilla is the first thing that comes to mind. Vanilla flavor is a common flavor and this is a common type of swap, the plain vanilla swap. Remember, it can be called a generic swap or a coupon swap. So in a swap, one person will pay at a fixed rate and another at a floating rate and they can both do net settle. It's simple concept. See, try to understand this part. I will pay the other person interest at a 10% fixed rate and then they will pay me at a floating rate. I'll pay 8% at fixed interest rate and he'll give interest at whatever floating rate is in market. Now we can net settle, can't we? I will pay at 8% and get an amount based on 8%. Whatever amount I got. And that calculated amount is, let me tell you, I will pay the other party 40,000 rupees, which is precisely 8% of 10 lakh. Then I will pay 40,000 to the other party for 6 months. Who am I? I'm Mr. A. Mr. A will pay. Mr. A receives how much? Mr. B pays floating. He'll pay on floating rate. What's floating rate? Suppose it's 10%. This means that he will pay 50,000 rupees and then Mr. A will also be receiving 50,000. What is the net benefit for Mr. A? And he is receiving 10,000 net. Mr. A is receiving it. How much is Mr. A receiving in net? 10,000. Mr. A says that he'll pay 40,000 fixed interest. Then you can give 50,000 of floating interest. Instead of doing that, we can do a net settlement. Look, I'll give 40,000, you'll give 50,000, so I'll have a net of 10,000 and you'll have a loss of 10,000 and I have a profit of 10,000. This is what you need to learn to calculate. This is all there. This is what I'm explaining in plain vanilla swap. That's it. There is nothing else. So I'll just tell you this one thing and explain in 3 steps. It's very easy. There is nothing to it. There are just a few assumptions that are made. Let me tell you about them first. Okay, look. The plain vanilla swap that happens in market, the swap contract, if you do it in the market, when interest is calculated, it's done based on days, not months, as a year is assumed to have 360 days. To calculate interest, a year is assumed to have 360 days. So you might ask, sir, why did you write 6 by 12? You calculated the amount based on months and I did that for simple explanation. Understand the working, I couldn't complicate it initially. So if you want to calculate interest, you should assume 360 days in a year. You will proceed by assuming there are 360 days in a year. So you will calculate interest accordingly, means in this swap interest amounts are calculated assuming 360 days in a year. You calculate the interest amount assuming that there are 360 days in a year. In practical life, this practice has been followed since swaps first appeared. So that same practice is continued even today. It doesn't make a difference, no problem. It is a market trade commercial practice. We will also follow the same practice. Just keep this in mind. Now, what are the steps to follow for net settlement? First of all, see how much the fixed rate payer will pay. Second, the interest payment by the floating rate payer. Both the fixed rate and floating rate payers will pay, and we just have to net these two. The net settlement is step 3. How much will fixed rate payer pay? It's very simple. We took the loan amount. We call this the notional principal amount. The contract can be any amount, right? Notional principal is multiplied by the fixed interest rate. This concept within a plain vanilla swap in the market, it is called the AIC rate. That is the all-in cost rate. In practical life, it will explicitly be written that the all-in cost rate in this swap is 8%. This simply means that whoever is the fixed rate payer in the swap will indeed make the payment at 8%. Ultimately, in technical language, the fixed amount of interest is called all-in cost and means notional principal amount. AIC comes into this equation, AIC or all-in cost. Just understand the fixed interest rate is given, the wording is just for show. All-in cost means the fixed cost, multiply by the number of days for which the interest applies, and then you divide it by 360, the number of days. The interest rate is per annum. The days of interest we were talking about is 6 months from January 1st to June 30th. Now we don't have to do calculation in months here, so let's calculate the days. 31 days in January, 28 in February, 31 in March, 30 in April, 31 in May, and 30 in June. Total 181 days. If the year is a leap year, then February will have 29 days. Don't think about exceptions. If it happens, we will see then. 181 days. So here it is 181 days. 181 by 360. Now second assumption. Now the second assumption for the swap. How many more? The only important thing in this swap is you should know the assumptions that are used in market. What are the assumptions that are in the market? The fixed rate payer in the swap will consistently calculate and pay interest by strictly assuming that there are precisely 30 days in every single month. A month is considered to have only 30 days, not more. This means if they pay interest for January, they'll do so according to 30 days. Even if the month of February has 28 actual days, interest will be calculated and paid for 30 days. They will pay interest assuming 30 days in every month for the 6 months January 1st to June 30th. Thus 30 into 6 totals 180 days. This has been the practice in market from the beginning. That's what is followed even today and will follow it in the questions as well. So just keep this in mind. N into EIC into number of days till settlement date divided by 360. I have explained N and EIC, and for calculations days are assumed 30 per month. It's very easy, you know this assumption. Now let's see how do we calculate the floating interest. Notional principal and multiplied by market's floating interest rate, then calculate rate for days divided by 360. Here too the same applies. Assuming 30 days, it will be 180 days. That won't work here. So what is this? This is the only thing you need to remember here. 3 assumptions. Interest is calculated by days. A year is assumed to have 360 days and applied in questions. Second, the fixed interest payer will pay the interest always assuming that 30 days in a month. But the floating rate payer will pay interest according to the actual number of days in each calendar month, and in this specific instance, there is no assumption whatsoever that a month has 30 specific days. According to the actual number of days. If January has 31 days, it will take 31. If February has 28 days, it will take that. So according to this, it's 181 days. This means it will pay interest according to 181 days. This is a general practice in the market. You have to follow it. You might think this is discrimination. The fixed rate payer pays for 180 days, while the floating rate payer must pay for 181. This is a general market practice. A common practice is not replaced. If you desire to replace it and it happens in practice, it will change. But as I tell you, there is no reason or logic behind these things, as in, is there any logic behind this practice? Like for example, when people get married. Because in weddings, there are many types of functions. People are just following them. There are some functions where they don't even know why it's happening. Someone must have started it for some reason, and it's just been going on till today. If someone wants to, they can stop it. If they stop it, then the practice changes. The practice will change. It's similar. Like before dowry system and sati practice were prevalent, they must have been started for some reason, but today banned. This practice simply continues in the market and it applies here. Now it's a market practice, I understand that, but the poor floating rate payer is being unfairly discriminated against. In practical life, there's no discrimination. Everyone knows what is market practice. Fixed rate payer will give pay as per 30 days and floating rate payer will pay as per actual number of days and will be at a loss. So for this, when the contract is made, the fixed rate payer's contract rate is always adjusted in the amount beforehand. Suppose the rate in the market is 7.9%. The fixed rate payer's contract rate will be 8%, so you have to give that. Interest on fixed rate. They adjust it beforehand. That's the arrangement. And both of them do it beforehand. You know, these things are done so that they don't have any loss. The third step is net settlement difference from fixed rate or floating rate payer payments. Step 1 minus step 2. You'll see gain or loss. If you look at it from the fixed rate payer's perspective, how much did I pay or I receive? Receiving more is a gain. If paid more, it's a loss. It's a simple thing. This is complete. Plain vanilla swap. Now the second type of swap is the plain vanilla overnight index swap. It is also commonly known as the OIS swap in short form. This is an extended form of the plain vanilla swap that we have just studied, a new model and a new version. It's just a newer model of it. A new model typically retains its base features, and similarly, the features that were in the plain vanilla swap will remain as they are. There's just one extra additional feature. Do you know what that additional feature is? You noticed in plain vanilla swap that poor floating rate payer was at a disadvantage, right? He was incurring a loss. In the plain vanilla overnight index swap, the floating interest payer will be discriminated against and gain another disadvantage. Plain vanilla swap features persist. Floating payer faces further discrimination. What kind of discrimination will be done? The interest of the floating interest payer will be compounded on a daily basis. Its name is overnight swap, overnight index swap. Overnight. This means the floating interest payer, for example, Mr. B, will make payment according to the floating interest. He will then calculate the interest payment that he has to make. He'll calculate today's interest. The next day, he will calculate interest on the principal at time 0 and the interest. The day after that, he calculates interest on the principal and the accumulated daily interest, which means interest on interest. His floating rate interest will be compounded daily and he will pay interest on daily interest. The fixed interest payer will have normal simple interest, but the floating interest payer will have daily compounding. Let's understand with an example once. Look how will the floating interest payer pay. For January 1st, with 10 lakh rupees at 10%, we calculate 1 by 360 for the first day's interest. What happens on January 2nd? The principal that was there and that interest. This was it. Take both of these, on both of these. 10% is applied daily, yielding 278. We have taken a small amount. If we had taken a large amount, this interest would have changed. That's not a problem. Let it be the same. We genuinely don't have a problem with that here. And then after that, questions will have large amounts and those amounts will differ. And then what about January 3rd? This amount plus interest. On this total, 10% daily will be applied. Here the interest is the same. Let's proceed with the normal process. It's the same due to the small amount, but over time. Now let's calculate it for the next date, say January 4th. Now how much is the balance? 1556, 278. So this is 1834 into 10% into 1 by 360. Now if you calculate this amount, so this is coming to 2780 right now. Okay, this will come much later. Sometimes this becomes 279 as it's less. If I took this amount in crores, the interest will start changing. Floating interest rates will change daily, and we'll consider this in questions. Just keep that daily in mind. Interest will be charged on interest. Interest will be charged on interest. You have to keep this in mind in a plain vanilla overnight index web. In a plain vanilla overnight index web, interest on interest will be charged, and you need to remember this for the floating rate payer. I have written a note, and please read this carefully. Sometimes the question might say assume 365 days in a year. Imagine a question on a plain vanilla overnight index swap appears. You might say in a swap we assume 360 days a year, and when you solve the question you get 0 marks. If the institute specifies 365 days, calculate interest using 365 days. Don't use your own concepts. The question's statement is final. Follow what the question says, as I have told you this repeatedly, because you make these silly mistakes. Then you'll write it in the paper and say, sir, I did it according to my 360 days. Will I get marks? You'll get 0. You'll get nothing. It's the institute's decision. We can't do anything. If they have written it, just follow that. Don't use your brain on it. Keep this in mind. Topic completed, and now the final topic. Use of interest rate swaps to reduce the cost of borrowing. We can use interest rate swaps to reduce our borrowing costs. The cost of borrowing can actually be reduced. You can think of it as a form of hedging by using a swap. If I take a loan, I can indeed get it at a rate cheaper than market rates by using a swap, and this specific financial strategy actually happens in practice. I have also worked on this in my practical life, as I told you in my articleship firm. There was a client there. They had used interest rate swaps, and I had done the working on it, all the valuation and other work. So this is practical. This is practically feasible, and companies actually do it. Because with this, your interest rate actually decreases, and in actuality, your interest rate can be reduced. There are chances if such a scenario arises. Now, how does this happen? Let me tell you about it quickly. We won't go into too much detail here in the revision. See, here is what happens. Now, one company needs a fixed rate loan and another company needs a floating rate one. So both of them can reduce their borrowing costs by entering into an interest rate swap. Both can reduce their interest rates in the interest rate swap by entering into the swap. This specific arrangement is applicable only if there is a company right now that needs a loan at a fixed interest rate. There is an existing company needing a loan at floating interest rate of the approx same amount and tenure. This is difficult to find practically. That's why I said that it can be used to reduce the rate. It is practically feasible. It can be found. How it is found, what is found, I will also tell you that. But such scenarios are quite rare, so it's not always very possible. But if an interest rate swap scenario arises, then there will definitely be some lacking in your interest rate. Your cost of borrowing will definitely be reduced if you have an interest rate swap contract with a party. Let me explain how this happens with an example. Later in this topic, we first understand it with an example, then it makes sense. A and B Limited are two companies and they both can take loan, but at what specific interest rate? For this example, let's focus on A Limited now. A Limited went to the market, to the bank to get a loan. It needed a loan. A Limited specifically needed a loan at a floating rate. A Limited went to bank to get a loan and then told the bank it needed a fixed amount for a fixed tenure. The banker then asked, will you take fixed or floating rate? I then said, tell me both of the rates. Then the banker explained the fixed interest rate and the floating interest rate. I simply said, okay. L plus 0.50, that is LIBOR plus 0.507% fixed rate. Similarly, on the same day, B Limited also went to the banker and said he needed a loan. It was also for approx the same amount and same tenure. And I asked him what will be the rate for fixed and floating. So the banker told him 8.20% for fixed and L plus 0.70% for floating. The banker quoted on the same day for a loan of similar amount and tenure. Why is that? Why is bank discriminating? Why does the bank quote different interest rates to two people for the same loan amount and terms? Is it wrong? No. This happens in practical life. Yes, it happens. Why does this happen? There is a reason for it. Well, I told you people's credit rating. A Limited might be a permanent customer of the bank. It also gives good business to the bank and has a good credit rating. So it is quoted a lower interest rate. Now B Limited is a new customer, doesn't have much business and its credit rating is not very good. The bank then charges higher interest. And this also happens in practical life. This is how business runs and there is no other way to run a business. Business is run this way. It is seen customer wise what to charge from which customer. This happens in practical life. So now see what happens. A Limited tells the banker that it wants a loan at a floating rate. So what does A Limited say? I want a loan at a floating rate. And B Limited says, I want it at a fixed rate. B Limited says, I want a loan at a fixed rate. This is what they both want. So A Limited is getting a good interest rate in the market. It has no problem because its credit rating is good. B Limited knows that its credit rating is not good. Its credit rating is not good. That's why the banker quoted a higher interest rate. B Limited knows this. So B Limited has not yet confirmed the loan and neither has A Limited confirmed it. B Limited comes home and is a little worried and calls his friend. He calls and luckily, do you know who his friend turns out to be? It's A Limited. A Limited turns out to be his friend and tell his friend that he went to bank today. I asked what fixed loan would you give for this amount, this tenure? Banker quoted 8.2% interest. And he said, you also know that my credit rating is not good and for this reason the banker indeed gave me a higher interest. Although it must be giving less interest rate to people in market. So A Limited said, what are you talking about? Today I also went to ask for a loan of the same amount. Now the banker has quoted me a fixed interest rate loan at 7% because my credit rating is good. My credit rating is good. So B Limited requested A Limited, do one thing. Take a loan at 7% on my behalf and give it to me. I will give you 7% and you can give it to the bank. So A Limited said, you are my friend. I can take it on your behalf. But I also need a loan today. He was like, anyhow, by any means, I also need a loan. I can take a loan today, but I also have my own requirement and I truly need it at a floating rate. So B Limited said to take a loan at a fixed rate from bank and transfer that to him. He'll give 7%, so he keeps giving that to bank. You can take your floating loan separately from bank and then let's understand a practical life point. Remember that getting a bank loan involves many things and it's not approved quickly in just 2 minutes. You get only one loan at a time. You have to provide many conditions, documents and everything. And it's not like you get 2 or 3 loans at once. That doesn't happen. So I can only get one loan at a time. Both parties can only get one loan each at a time. So B Limited told A to take a loan at a fixed rate and give it to him. He will benefit from it. A Limited said, you will benefit, but what about me? I also need money. I also need money and I also need a loan. If I indeed take this specific loan and then I will give it to you, then you'll benefit and you'll save on interest. Your work is done and as your friend, I have no loss. But I also need loan. Where will I get the money? Where will I get the money from? So B Limited gave him a solution. If on my behalf, you could please take a loan for me. You will then take this loan at a fixed rate of interest on my behalf. So in this transaction, see in this transaction, in this arrangement, we will save 1.20%. Now, how much will we be gaining from this? We will save 1.20%. Look here. B Limited said that I will save this much interest. I said, yes, you will save that. That's right. But what about the loan that I need? So B Limited said, you take a loan at a fixed rate and I'll take the floating rate loan. A Limited said, okay, if I take it at a fixed rate, we will save 1.2%. But if you take a loan at a floating rate and transfer it to me, then see, I am getting a cheaper floating rate. I get at L plus 0.5 and you at L plus 0.7. So I told this to B Limited, to which B Limited said, even if I take a loan at a floating rate, so hear me as in B Limited, I will take a loan at a floating rate. If I take it at this rate, I will transfer the loan to you, then you pay me the floating interest. Further give it to bank. So both of them have a loan. There is a clear loss here. So if A Limited took a floating rate loan, it would be L plus 0.5 and B Limited at L plus 0.7. This means there is a loss of 0.20%. There is a loss of 0.20%, but we will have a profit of 1.20%, right? Let's consider the total transaction. So we will still have a net benefit of 1%, right? We will have a net benefit of 1%. So A Limited said you are getting the benefit, not me. So B Limited said, listen, we'll split this 1% gain between us, then divide it in a certain ratio. Let's say half each, 0.5 and 0.5, or in some other ratio. Like A Limited can keep 60%, 0.60 and I'll keep 0.40%. This is what happens. This is what swap is. Now let's understand how this works and how the benefits will be divided. Now let me explain this very thing a little more. And then I'll show you practically how this process happens. So what did A Limited want? Look, A Limited wanted floating. B wanted fixed. So what they decided was that A Limited will take fixed and B will take floating. Which one will B take? Floating. So how will they benefit? Now listen carefully. Now I will show you the calculation again, and this time in a much more logical way. If both parties had directly gone to the bank and taken the loan they wanted, what would have been their total cost in terms of interest? We have to look at the total. Now add 8.2% and L plus 0.5. L plus 0.5 plus 8.2 gives L plus 8.7% their total combined cost. But if they both do a swap, meaning they take the other loan instead of the one they want and then interchange them, thereby completing the swap, then this will be 7% and L plus 0.7. What's the total? 7 plus L plus 0.7 is L plus 7.70. If they took it directly, it would have been L plus 8.7%. Through the swap, it's L plus 7.7%. You can clearly see the difference between the two. L cancels L and 8.7 minus 7.7, that is a 1% gain. Didn't I just verify this 1% gain? There's a 1% gain if we do a swap. If you understand, otherwise batch students watch the regular lecture. For the concept, I explained it again anyway. This topic is free marks for exam. I'll give you the steps now for free marks, but I'm still explaining the concept. People face concept problem. So there was a 1% gain and they will share it among themselves. Their interest cost will be reduced. How much will it be? What will it be? I will explain all that too. Just understand this much of the process for now. This was the main thing. So you see a gain in swap and that should be shared among yourselves. Now you all see. So you have narrated this whole story, but is this practically feasible? That both companies at the same time loan needed of same amount and tenure. At different interest rates, one floating, one fixed. And they both also turn out to be friends. Practically this is not feasible. They are not friends, not feasible at all. This is a very rare coincidence. If it happens, that's great, go for it. So how will it happen practically? So practically the bankers also facilitate this business. Bankers give loan at different interest rates based on their credit ratings. And after that, they get them to swap. After that, they also do the business of swapping. Banker also do the work of swapping, then called the swap banks. You can go to any bank, take a loan from another bank and get the swapping done by someone else. They will do it if the scenario is available. So then the banker said, the banker would introduce them and A Limited sought a swap with B Limited. A and B don't know each other, but the swap bank will coordinate between them. And it will take a commission because it is not working for free. You could see a 1% gain in the swap and the bank now wants a share too. Remember what I mentioned about Pankaj Tripathi in Luka Chuppi. When Karthik Aaryan is sitting with someone, he will then follow him around. He sees a benefit being gained and then he demands, I want a share too. Similarly, the swap bank then intervened. Seeing A and B Limited's desire to lower interest costs, the swap bank intervenes, demanding a share for connecting them. So he will also take a commission. He is saying, look, you are getting a 1% benefit in the swap overall, right? So give me a 0.20% commission. Meaning there's still a net gain of 0.80%, right? So we'll say done. We'll share the 0.80% net gain like equally at 0.40% each. Understood? That's it. This is a swap. So just look at this example. Loan interest rates are given for both. A wants floating, B wants fixed. So this question is a kind of example question that comes. The swap bank can arrange the swap, but it will take a commission of 20 basis points. From AFM, 100 basis points means 1% and 20 means 0.20%. The swap gain will be equally distributed between both parties as stated. Now tell me, can this specific swap arrangement be beneficially implemented if there is a net gain? A swap can be done if there is a net gain, but if there is a loss or it is zero, then a swap cannot be completed. So now you have to tell that first. So step 1. In step 1, you can calculate if the swap is beneficial. See what the total interest rate would be if we took the required loan directly. What was the required loan? A is floating and B is fixed. Total them. If we go through the swap, then consider the other loan's interest rate. A takes fixed pay, B takes floating. It's total. So a total gain of 1%, but the swap bank will also ask for its commission saying, I also want a 2% share. What is the net gain? It is 0.80% and this net gain will be shared equally by both parties, each receiving 0.40%. The second thing, if swap is beneficial, meaning the end, if yes, then you have to calculate the net interest rate cost of the loan to both companies by using fair value. What was the net interest rate cost for both companies after using the swap? What was the cost? It's very easy. Both gained 0.40% from the swap. Now look, which loan did A want? Now we have to see that which loan did it want. So if it had taken a floating rate loan, what would have been the market rate? L plus 0.5. In this, it got a benefit of 0.4% through the swap. So this comes in just 2 clear steps. The second step involves calculation of the net interest rate cost of loan by using. For Delhi Limited, what's its market floating rate? L plus 0.5 net gain share. So the applicable cost will be L plus 0.1%. Which loan did B Limited want? Fixed interest. Market interest rate for B Limited, 8.2% swap benefit 0.4%. This makes it 8.2.4. This share in net gain was deducted to 7.8%. This is its cost. So this topic is completely finished here. I'll show you the procedure once. I had given a logic here. Some people might think a bit differently here and they will say that, sir, A Limited. A Limited's loan was fixed, not floating. B took the loan at a floating rate, so subtract 0.4 from L plus 0.7. No. The net gain that A received, this is based on its own market interest rate. Here the 0.2% loss that was there, we have already adjusted it here. Look, we can give the impact of all that. I can verify this as well. I had done it in class. It will work in the same way. In the second step, the loan you wanted in the market, look at your own interest rate. From that, you will take your share in the net gain. The applicable rate on you determines your share of the net gain. It is not the rate at which another person takes a loan that determines your share. What is the market rate on the loan you wanted? You'll take a share of the net gain and benefit in that. If you want verification, I'll do the topic again once. What are the steps? First, determine if it is a beneficial swap. If both parties take the required loan directly, calculate total interest, and if they swap, consider the other loan's rate. Total interest, gain or loss. Remove bank's commission and take net gain or loss. On net gain, then a beneficial swap can be done. This net gain will be shared by both parties in swap deal as per what's written in agreement. Second step, the net interest rate cost in the swap. Look, the party taking loan at a fixed rate. For the fixed rate payer, deduct their net gain share from the market's applicable fixed rate, and for the floating rate payer, subtract their share from the market's applicable floating rate. Complete step. Let's understand the logic. How will this swap be made in this way? I explained with an example to understand quickly, then no deep detail. A wanted a floating rate loan, but if it's doing a swap, it will take a fixed loan at 7%. B wanted a loan at fixed rate. Doing the swap, it took a loan in the market at a floating rate of L plus 0.7%. Now look. So B Limited. Our final net interest rate cost. What was B Limited's fixed interest rate? It was 7.8%. B Limited took a floating loan, not wanting it, passes this to the swap bank, which provides it to A as a desired floating. Now A took a fixed rate loan and B doesn't want that. It takes and give it to swap bank, and swap bank will take it and give the fixed rate loan to B Limited because that's what it wanted. Is that clear? Now let's examine B Limited. Took a fixed rate loan through a swap, so it will have to pay fixed interest to the swap bank. How much? What was the cost to it? 7.8%. Let's take this once to verify. 7.8%. 7.8% came, and the swap bank will transfer this fixed interest to A Limited. How much? 7%. Why will he give A Limited only 7 when he got 7.8? Because what A Limited has to do is give 7% fixed interest to its lender. A Limited didn't want the fixed loan, yet must settle it fully regardless of lender. It will tell the swap bank that I took a fixed loan and I gave it to you. Give me its interest so that I can settle with my lender. Okay, I have nothing to do with that. The bank will transfer 7% to it so that it can settle. So its settlement will be done. Understood? The swap bank took 7.8% from B Limited and profited 0.80% from 7% transferred. Now look. B Limited also took a floating rate loan. It has to pay the floating interest on it. Where will that come from? From A Limited. The floating rate loan B Limited had was transferred to swap bank, which then gave it to A Limited. Who receives A Limited's floating interest? The swap bank. In our example, what was the net interest cost for A Limited? It has to pay L plus 0.10. How much floating interest will the swap bank give to B Limited? L plus 0.10? No. B Limited has to give L plus 0.7 to its lender. B Limited will say, look, I had nothing to do with floating rate loan. I wanted a fixed one. I must definitely give L plus 0.7 to the lender. So give me L plus 0.7 only. So swap bank collects this and its net settlement happens. Transaction is finished. Okay. So the swap bank in this transaction got L plus 0.10. How much did it lose? L plus 0.7, meaning it made a loss of 0.60%. So the net swap bank kept its profit of 0.20%. The entire swap transaction is complete. Look, everything has been settled. The swap bank made a profit of 0.20%. I'll show you again if you want. The swap transaction is completed. If you look here, A Limited received its 7% fixed interest and then settled that fixed amount directly with the lender. B Limited got L plus 0.7 and it settled the floating lender. B Limited just ultimately paid interest at a fixed rate for the fixed loan it wanted. It happened in the swap. A had wanted floating, so paying this amount in the swap. And by doing all this, swap bank ultimately made a net profit of 0.20%. This means entire swap structure is complete. The rate we calculated is absolutely correct. So how do these rates come about? The rate that is applicable to us on which we need a loan. From that we remove our share in the net gain. Rest details will be in the next lecture. That's all there was in this topic, and with this I have revised all the concepts of this entire interest rate risk management chapter for you in detail. You didn't have trouble understanding this. So now you all should read the notes once, and then for those of you who are class students, kindly go through the question bank solutions that I have done for you in class. Go through all of that and kindly revise from the solutions we have written. Looking at them directly will not work. And students who only attend revision video, not taken my classes and have studied from somewhere else, you don't need to worry, as I have explained this concept in full detail. Read the notes and solve the question bank first. Don't look at solution directly. First solve yourself according to steps. Then match your answer. If you look directly, you will see things up and down. Then you guys will message me, sir, what did you do? Then I will say the same thing. For class students, solutions from class are available. Those not from class, you guys first do your own solution from this tab that I told you. Then match. If you have a doubt, message me. So you have to follow this procedure. It's not like you just listen to the revision video and directly from the teacher from wherever you might have studied, from their book or from their module or the question bank, and you started matching from there how to match that, then nothing will happen. Then it won't make any sense. So do solutions yourself. Students who attended the class should consult their solutions for effective revision. I have explained them to you in full detail. I also used 1 or 2 questions for reference just now. You will not face any problem. This chapter will be very easy and it's simple. I have done everything well. So if you liked it, then what you should do, like the video. You can let me know in the comments whatever it is, and if you have any query, you can also put it in the comments. If you have liked the video, you can suggest it to your juniors and friends, and you can also share it. So that is all for today. Thank you so much. Hare Krishna.